research around whether or not it's even constitutional to do that. Will there be a push by a lot of standing ranking members that already are older to instate different measures that could put some sort of check on this?
And once again, Washington, D.C. finding themselves on the wrong side of the mood of the rest of the country. Because the rest of the country would like these kind of things to happen.
Are we looking
based
for
on polling?
Another John leader?
What, Senator?
The Senate? Yeah.
Yeah, no.
More Johns?
No.
No?
From New York, this is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
Viewer writes in, I don't think you're liberal enough to win the seat in New York. It's kind of brutal. I mean, they don't know my politics.
No clue.
No clue.
You were talking about being the fourth John in the Republican Congress.
Yeah.
All right. Well, it's true. Nobody knows you.
No, of course not. Equities right now on the S&P look like this. Futures. Keep it together, Brahma. It's rude.
Carry on.
Futures on the S&P, negative by 0.2% on the S&P 500. On the Nasdaq, we're down here by 0.2% as well. The Russell, tough day yesterday on the Russell. Small caps getting hammered. Not bouncing back this morning. We're down by 0.1%. Tough couple of days for the Treasury market as well. Switch to the board and get to the bond market. 2-year, 10-year, 30-year. 10-year yields lower by a couple of basis points at 423.81. The previous 2 days had a 16 basis point move in 2 sessions on Treasury. Treasuries. I get it, really busy day for corporate issuance in yesterday's session, pushing yields higher across the curve. And there are days when you see that, Lisa. You start months like September, you get tons of supply from the corporate side and it kicks around the bond market. But it was Friday too, and there was a rally in crude that got everyone's attention, and you wonder what's really taken us here.
Especially if the shift has to do with this increasing, I don't want to say consensus, but less contrarian than it used to be short bet on bonds. If you do think the Fed is going to use every excuse to remain on hold, and you see longer-term strength percolating out, well, then all of a sudden real rates start kind of creeping higher in the face of that.
Let's talk about that move in crude. Crude looks like this morning, 390 for the first time since November. Brent crude this morning down by 0.6%, $89.46. Some warnings about how high jet fuel prices have gone over the last couple of months, 20% higher since the middle of July, according to United Airlines. So United with a warning, higher costs, a warning from Southwest, a warning from Alaska Air, all of that later in the last 90 minutes or so.
Would you fly the same routes if the prices were 20% higher? Is it sort of the price sensitivity that's going to drive people's travel, or is it going to be just the desire to still get out there? I don't know the answer to that, and that's sort of one of the key questions underpinning this. Are they going to take that 20% move and just say, actually, that's the reason why we've got to charge you more, sorry, and by the way, reduce the number of flights going in and out so we can jack up prices?
Is business going to make a comeback, one, and is the revenge spend going to continue? Two, on the second one, I do wonder, because we were getting told by domestic airlines, domestically focused airlines through earnings season, and maybe things were flagging a little bit, and they had to soften fares domestically here in the United States. The international stuff, I've got no idea. I think a lot of people have seen those things on Instagram, Italy, Greece, what's happening in France.
They saw them 2 years ago.
They want to go on vacation. They want to go on vacation. Didn't we get that in the consumer confidence survey? Didn't they say their intentions to go on vacation
Everybody
were much
wants to go
higher?
on vacation.
I couldn't work out whether that was real. If they're actually going to spend that money on vacation, or they just want to.
There have been stories about how cruise liners are getting pushback from different cities. They're saying that they're just mobbing all of the ports and that it's just getting a little bit out of control. So, which I totally agree with, by the way.
I couldn't agree more. You want to trash cruise lines? Let's go. I'm always ready for that.
I'm not going to trash them. I'm just going to say there are towns that are starting to try to restrict some of the foot traffic just because it has been so high.
As they should. As they should.
Oh, man. You are in campaign mode.
Never doing a cruise. I hate it when the cruise ships rock up. They spoil the view. You ever see that?
Yes,
beautiful
yes,
port,
yes.
Great, fantastic view.
About somewhere in particular?
Yeah, beautiful boats in the bay, some of them docking, lovely, gorgeous stuff. And then this massive thing, this tanker with a hotel piled on top of it.
Now the people come out.
Pulls up
and
and just spoils everything.
You know, I think that if people like cruises, all the more power to you. I think that there's just an issue of how much longer people can keep doing this and whether they can keep jacking up the prices.
How much longer they can keep cruising. I agree. Under surveillance this morning, Japan's government defended the yen verbally after the currency set a new 10-month low. The vice finance minister for international affairs saying, quote, if these moves continue, the government will deal with them appropriately without ruling out any options. Now, Lisa, my question on that would be, okay, what are you going to do about it?
Which is the reason why you didn't really see much of a move. The move was very short-lived. My favorite was this one FX strategist who came out and said, we have jumped from level 4 on our verbal intervention scale straight to level 6 or 7, and a warning of imminent FX intervention, and markets don't care. I just think that that's really telling in terms of where people think the follow-through is going to be.
Pushback not just from Japan, pushback from China as well. A record-setting rally in China's property sector on bets the government is preparing more stimulus. Evergrande closing up 83%. I know it's basically a penny stock, but still, what a move, making it the largest gain since its listing in 2009. China's recent property developers still reeling, however, from deepening financial problems. So this ain't over, but that was quite a squeeze overnight.
Yeah, my favorite part about this is bad news so bad that it's good over in China developers. Is this basically looking at the fact that you could have a defaulter candidate pretty much across the board in the majority of developers in China, and that's being viewed as a positive because there's no way the Chinese authorities are going to let this happen. To me, highlights just how much people believe that China's assets have been beaten up. And just like Leland Miller said, maybe it's not as bad as people expected.
Is China in focus for the Europeans as well? The largest economy continuing to feel the brunt of poor demand from China. More disappointing data out of Germany. Factory orders plummeting nearly 12% to start the third quarter. They dropped fast, surpassing the 4.3% expected in our survey here at Bloomberg. Difficult day for Germany. So yields higher off the back of some hawkish ECB speak. The DAX lower off the back of some pretty weak data and some concerns over in China as always. Lisa, what to do with all of that?
Germany is in a really tough spot, and I think everybody really would agree with that in the sense that their factory orders are down, probably in part because of China. They're probably the most exposed of the major European economies to China. And at the same time, services also not coming back, actually diminishing. Where is the growth going to come from at a time where Germany still has continued to really push into China? We saw that shift in tone from Mercedes recently, which I thought was interesting, shifting away a bit from China and saying maybe they aren't going to rely as much. That's new. And how much is that coming from the government?
The boom is over, based on that interview with the Mercedes CEO.
Which boom?
The boom in China specifically. I think what they underplayed was the competition domestically in China. You know, when German manufacturers just had it their own way all the time, that seems to have changed a lot.
Well, pretty much for
Where's the leadership been in
international.
German manufacturing over the last decade or so?
They are between a rock and a hard place because right now, based on where they are, they can't really change without torpedoing the economy entirely.
Allowing a sports drink manufacturer to dominate Formula One in the way they have, you know?
Is this personal?
No. Sonia Martin joins us now, Head of FX and Monetary Policy at DZ Bank. Sonia, wonderful to have you with us. I want to talk about that hawkish ECB speak from two officials a little bit earlier this morning. Is there truly some two-way risk in that ECB meeting a week tomorrow?
Good morning. Yeah, first of all, let me just quickly state that as a passionate sailor, I agree with you that cruise ships are an abomination.
You're welcome back anytime.
Moving on, moving on to the ECB, what we have seen is a lot of division in the council. So, you know, for a long time during COVID and the last year, we saw the council, you know, unusually united, but that has changed completely now that we're nearing the end of the rate hike cycle. And you see the hawks and the doves sort of, you know, positioning themselves. And I wouldn't really count too much on what individuals are saying right now, simply because there's a split in the council and they're sort of each talking their book. And that's what we saw this morning. I think the ECB is still very much split on what to do next week. And I think it's a bit of a 50-50, and this is what the market is pricing in, on whether they will actually hike one more time. We don't think they will, but of course there is a risk given that we still have quite high inflation. But as you pointed out, I think earlier on as well, we have a lot of weakness in the economy coming through, and that's something they'll have to keep in mind.
Sonia, how much are they watching and focusing on the euro and the foreign exchange transmission mechanism at a time where you have commodity prices going up, you have a stronger than expected U.S. economy, and suddenly the euro, again, is struggling to climb out?
Yes, generally speaking, obviously in this sort of environment, you know, you don't necessarily, in terms of the inflation outlook, you do not want a weaker currency. For the export market, it's of course good news. I don't think we have to particularly worry about the level of the exchange rate in the Eurozone at this particular point in time. You know, we have been trading, you know, 110 plus minus big figure for quite a long time now. And I don't think it's something that the ECB is overly concerned with. That might change should the euro continue to deteriorate, but it would have to be an aggressive and fast move. And I think we're miles away from this at this point in time.
Why is there such a push toward hawkishness? Is there a sense, or at least hawkish rhetoric, at a time where a lot of people had priced out a rate hike next week? Is there a sense that financial conditions are not tight enough, despite some of the moves that we've seen in yields?
Actually, I think it has to do with something else. I think, you know, figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks. But it's really a lot more difficult right now than it was in the past because of the experience we've had in the last year with this incredibly high inflation. So I think what they're trying to do is strike a balance. On one side, they should signal the end of the rate hike cycle, either that it's already there or it's coming. At the same time, I think they do really want to keep the door open for additional tightening should that be necessary. So they just don't want to shut the door. So the combination, the compromise could be still quite hawkish rhetoric combined with, you know, we'll wait and see what happens. And I think that's the most likely outcome next week.
Sonia, how much can I read into what's developing in Eastern Europe with central banks like Poland potentially reducing interest rates? Sonia, as we know, some of these countries actually led the tightening cycle before places like the ECB, the Federal Reserve, got going. Do you think they're leading the cuts as well?
Well, there are, as you said, a number of countries, also when you look at Latin America, that are already cutting rates, but they did start very early, and this is a different scenario for them. They've already done a lot, and they now have to retrace. I don't think that's a signal for anyone else per se. What it does confirm, however, is that we are seeing really the turning point in global monetary policy. And I have to say, I find it kind of bizarre that we are so incredibly focused on whether or not the ECB or the Fed will tighten one more time, because ultimately that is not going to change anything, is it? So why are we so obsessed with this discussion? Normally at this point in the cycle, what we would be talking about is the potential rate hikes next year, but that doesn't seem to be happening. We're totally focused on the next 2 weeks.
So some people are talking about the potential for that to develop. City's Andrew Hollenhorst at the Federal Reserve talking about that. Neil Dutta of Renmark considering the potential that maybe things pick up again. Sonia, is that a conversation in any way, shape or form at the ECB? It feels like things are a little bit more split here at the Federal Reserve. Is it over at the ECB?
That discussion isn't happening right now, but it will happen. And I suspect, and when it does start to happen, it will take some people by surprise. In fact, I would say that is also going to be the case in the US, because while the market is pricing in rate cuts next year, it's not something we're focused on right now. So what's going to happen, once we move past the next few months and we move into the winter, the economic downturn, it's really going to hit. And I think that's when people are going to start focusing on rate cuts. And I think that's going to create a lot of volatility in the market because, everyone's sort of ignoring that for the time being. So that is still very much in the pipeline for next year. Not early in the year, more towards the middle of next year.
Sonia, thank you for the update and for your love of sailing and your hate of cruising. Sonia Martin there of DC Bank. Sonia, thank you. If you are just tuning in, welcome to the programme. Your S&P 500 negative here by 0.2%. Just a little bit of feedback out there, Bramo. The cruise thing is going to decimate your voter base amongst the seniors.
Well,
I think
true.
some people are taking this a little bit too seriously.
Are there cruises that are more acceptable than others in your view?
No.
What about to remote places where the small cruises?
One caveat. All right.
Okay,
River cruises, I think, yes.
River cruises are okay.
Smaller boats.
Okay, river cruises.
Smaller boats, more exclusive, more private, less disruptive to the environment and your surroundings.
No, don't even try to make this your environmental pitch.
Yes, absolutely.
You
Why
think
do you
so?
believe that? Yeah,
Okay,
sure.
you think that the other ones are not sufficiently environmentally
I think
friendly?
river cruises are a lot more appropriate.
Is it because you're looking at one river cruise in particular in Alaska?
I would consider doing a river cruise. That would be, but I'd need all of my friends on the boat with me. That would
all right then,
incredibly
fine.
exclusive.
Okay, there we go.
That's as far as I'll go.
Okay.
All right. I want to go back to the consensus view on the bond market. Can I do that?
Please
I'm
go
going to do
for it.
that. Jim Bianco Research. I'll go back to that quote. The contrarian players, short bonds, no recession, sticky inflation, no cuts in 2024. Isn't that kind of what Sonia was talking about there as well?
And that's where I was going to say is basically increasingly just on the margins, entering the mainstream discussion, you're starting to hear what happens if you get that real re-acceleration? And to tie it into the commodities play, what happens if the increases that we've seen, not just in oil, but in copper and beyond, in iron ore in particular, less than copper, and also in food, is really tied to strength and demand and stickiness and inflation that's going to prompt further moves early next year that's going to surprise the market. That could be a real game changer.
My environmental concerns playing well in New York, just so you know. All right, AMH writes in, Rhine River Cruise. Rhine River Cruise.
Is she the one in New York?
That's what
Who's actually
Anne-Marie
DC?
would like to happen.
Okay.
AMH, a Rhine River Cruise.
Is that what you were thinking of? I thought you were thinking of the one in Alaska.
I like the idea of the fjords.
Yeah, the fjords are gorgeous.
It's beautiful. Yeah,
and
yeah,
honestly,
yeah.
it's hard to get to places and you see the sea life. I can get behind
If you've got a massive yacht, you'd lend me, to go and look at the
I'll try to drum one up. I'll see if I can pick one out of the jet stream.
Kevin Booker, Clearview Energy Partners, up next.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
At the end of the day, we've had this just bearish onslaught of Russia news and of China news, and what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership.
Getting back on the show a week ago, Chris Ferrone of Strategas talking about crude getting to 90, crude through 90 in yesterday's session for the first time since November. Just quite the rally that's developed over the last 2 months, Lisa. A 20% move on oil.
And why? And this is really the question. Is it just because of Saudi Arabia coming out and saying, and not just because, this is not insignificant, saying that they're going to continue with a 1 million barrel per day cut in production? Or is this something more in terms of strength that is underpinning this? I mean, I keep going back to Leland Miller. China's economy is doing okay. It just isn't doing quite as well as it previously had been expected to.
Just pulled up oil production in America on the Bloomberg. 12.8 million barrels a day. Just short of 13 million. And we're looking at prices like this.
A record amount of production that's fueling, supplies at a time where, there's been some speculation. Maybe people are using less gasoline because of electric vehicles, and that's why oil demand hasn't been going up as much as it should be. It doesn't make sense if you put it all together. There isn't a cohesive narrative unless there is some strength underpinning the moves that we've seen.
Kevin Book joined us now, Managing Director of Research at Clearview Energy Partners. Kevin, what is crude doing in the 80s with oil production in America at 12.8 million barrels a day?
Well, it's prospering. It's going ahead and reaching for the skies because some of the biggest producers in the world, other than the U.S., are cutting supplies to the world. And when you look at the Saudi Arabian and Russian decisions in recent days, I think traders are starting to finally take them seriously. Prince Abdulaziz, the energy minister of Saudi Arabia, referred to the 1 million barrel voluntary cut as a lollipop. It's starting to seem like an all-day sucker, a really long-lasting effect. And that's getting priced in now as well.
Kevin, they're talking up monthly reviews. Are you saying in that monthly review, nothing's going to change?
Well, nothing has changed so far. That is a caveat that leaves room for opportunity. I think the kingdom in particular is wary of crushing economic recovery wherever it might occur and stalling the economy generally, globally. But right now, it looks like there's still room to run. So no, we from the very start, if you looked at it, the $75 barrel worked backwards from an elasticity effect. It looked like it should have been about a $9, $9.50 per barrel impact from the $1 million cutback. The market didn't price it in right away, probably because it thought it was evanescent. But now that it looks enduring, yeah, sure, we're looking at a real premium.
At this point, though, how much is this also driven by the fact that growth isn't as bad as people previously expected in places like China and even Europe?
Second half of the year is always a bigger demand part of the year than the first half. My colleague, Jacques Rousseau, who you have on from time to time as well, he points out that we're looking at about a 4Q 2.1 million barrel demand ahead of supply. So that deficit is going to be pretty enduring. There's a lot of that demand concentrated, yes, in China, a lot of it in jet fuel. That increases the risks if there's some sort of hiccup over there, but it doesn't change the overall dynamic when we're looking at a sort of a seasonal effect.
There's also a question around what the bogey is for Saudi Arabia and maybe even for Russia. Is there a sense that they're trying to get oil prices to a certain specific level before they'll start to try to balance out some of their supply versus the demand?
Well, I think that there are two separate things that have to be taken separately. The kingdom is aligned with the Kremlin very explicitly as a matter of business, not politics. And if you look at the Kremlin, they've figured out that revenue is equal to price times volume. And if they're going to cut volume, a higher price works for them. The differences, though, are one country funding a war and another engaged in a very sophisticated and elaborate negotiation towards expanding the Abraham Accords. I don't think that the kingdom is looking to blow up that opportunity, difficult though it may be, and with many steps yet to come.
How important, Kevin, is it to refill the SPR? And how likely is it we're going to do that anytime soon?
Well, the Energy Department made it pretty clear, John, that there's not much interest in doing it at this price level. They pulled back from their requisition for 6 million barrels of additional volume. But how important is it? Look, that's a matter of opinion and perception. There are some who would say that the SPR was never needed, and especially not now in a world of shale. I've testified at least 6 times on the Hill that it's an insurance policy, and the insurance is cheap when you look at what it can do to prices to draw it when you need it. So I would be in the camp that it is worth refilling and should be done as soon as it can be affordably done.
So effectively, to build on what you've testified, we don't have that insurance policy right now, Kevin. So how vulnerable are we?
Well, we have 350 million barrels of oil in the SPR still, which is not trivial. On the other hand, what we don't have is the full carrying capacity of the reserve, and we don't have the clarity that conveyed when it was bigger. I think that was not only a message to the world about insurance against economic risk, but also a message to producers that if they didn't take up the slack and bring the market back into alignment, the U.S. would undercut them and take away their premium.
How awkward does this make the meeting between President Biden and Mohammed bin Salman of Saudi Arabia expected in the next few days or so at the G20 meetings?
I mean, I don't think it's going to get in the way of a fist bump. Look, the currency, the economic currency of oil trade remains the dollar, much to the chagrin of some who would think otherwise. The political currency of oil prices remains blame. The challenge for the White House is not just geopolitical, but also domestically political. The usual steps in the process of prices rising is for a White House to blame overseas producers, domestic producers. In this particular case, blaming overseas producers very much complicates the negotiation. And you saw Jake Sullivan yesterday very specifically avoid blaming the kingdom, as he and former National Economic Council Director Brian Deese did in October. And now at home, you also have producers, some of them aligned, at least notionally, with the White House climate agenda, probably not going to want to blame them, at least ahead of the Conference of Parties in Dubai. So maybe a little lighter on the blame and more room to talk.
Given that there isn't going to necessarily be a lot of action that necessarily comes from these discussions based on the unwillingness to really place blame, what is the offset? What is the off-ramp for oil prices going even higher? Why aren't we going to stay at these levels and go even higher from here for the near future?
I'm not sure you would want to bet against going higher, but there are obviously the economic fundamentals decay when prices rise. American drivers are pretty resilient. We can see that right now. On a trailing 12-month basis through July, though, we estimate that you're talking about some 600 plus gallons bought over the year through July by the average driver, more, by the way, in red states than in blue states. So there's economics and politics to that. The other side of it, though, is where you get more supply. Look, it would be difficult to say this, I think, from the White House perspective, but a certain amount of realpolitik is already at work on sanctions. The unspoken mini deal with Iran brings sour barrels to market. Sanctions leniency with Venezuela that could be crafted ahead of the election next year to induce democratic reforms. That, too, looks like another source of barrels. And maybe a certain amount of pragmatism in enforcing the price cap on Russian barrels to third countries. So there are heavily sanctioned countries where the White House can take a light touch. It looks like they may already be doing so or poised to do so.
Kevin, do you like cruises? That's all we want to know.
I like cruising in a car slowly down the street on a hot summer day.
Sounds
trapped
wonderful.
on a boat with nothing but food and booze, not so much.
There we go. We're on the same page. Kevin, thank you. Kevin Burr of Clearview Energy Partners. Just rounding up the team.
Now
getting everyone on the same page.
You realize you're making me want to defend the cruise industry.
I know, that's so on brand.
Which is, well, I mean, come on, that's how I think. So now I'm going to start looking for arguments against
you
that.
can do that.
Yeah, okay.
I want to bring up this currency pair right here. Dollar lira. Bang. What a move. Stronger Turkish currency. We're down on that currency pair now by about 0.1%. So that's in the Turkish lira's favour. This headline right here, maybe a leopard can change its spots. Erdogan of Turkey. We will reduce inflation with tight monetary policy. That's new.
Yeah, that is. I just immediately went to the profile of the new central bank governor, Hafiz Gaye Erkan, who's this young woman who came from Wall Street to really lead the central bank. And I wonder what influence she's having over Erdogan in this new reformed way that maybe you have to follow conventional monetary policy in order to have some sort of conventional inflationary outlook.
that headline from the Turkish leader just moments ago. It's amazing to see. I wouldn't say it's surprising given what we've seen develop over the last couple of months, but certainly surprising relative to where we were a couple of years ago.
Well, yeah, I mean, if you think about it, his response, Erdogan's response to high inflation was to cut rates because that was going to be the way to juice inflation. And anyone who disagreed with him was ejected from the central bank. So what kind of new shift in leadership is there to change this approach? And suddenly you're seeing downgrades to the Turkish outlook for growth. What is this?
I used to sit down with the central bank governors of Turkey, and I always used to say that they had the hardest job at central banking, because these were some highly credible, intelligent individuals in that seat a lot of the time. And you knew what they wanted to do, but you knew they could only go so far. It was such a tough seat to be in. That move right there, dollar lira, 26.76. David Leibovitz of JP Morgan Asset Management is coming up next on this equity market. The rally stalling just a little bit, futures negative 0.2%.
From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from it.
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We have an unsustainably strong economy still.
Yes, things are slowing, but they're not
collapsing. You shouldn't be underweight equities at this point in the cycle.
Everyone keeps saying, let's be bullish the bond market, but look at the price. Look at the price all summer. It has continued to go up in yield.
Bad news is good news when it's just a little bit bad.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Alarian writes in, Nile River Cruise. Nile River Cruise.
I can get behind that.
That's the last of the cruise chat this morning. From New York City,
No way.
good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK with a day off. He's going to be back tomorrow. Bad news is good news, so long as it's just a little bad.
I love that quote. It's
Okay,
just
Steve
fantastic.
Chevron of Federated.
You know, this is where we're at, is that basically you could have something that softens the outlook for the Fed, but not enough that you actually get the hard landing. So if you have growth, but you have a Fed that just to right-size things cuts rates, that's the Goldilocks that was the narrative, I would argue, a couple of weeks ago, but seems to be shifting a little bit on the margins.
Is $90 crude bad news or good news?
It depends why. It seems like people are trying to parse who it's good for and who it's bad for. I would argue for the Federal Reserve, it makes it very complicated. And I think that the airline industry very much highlighting that, coming out this morning and highlighting the increase in their costs tied to diesel, tied to crude. How much does that really end up getting passed along to consumers who just have to eat it?
Let's get those airlines up and have a look at them right now in the pre-market. Southwest is down by about 4%. The note that we got from Southwest, I think, was pretty interesting, Bramo, that essentially they're all coming out and saying the same thing. Fuel prices are up. But Southwest also said they continue to expect solid profits in the third quarter and full year 2023. So to your question, do they eat it or pass it on? Are they kind of telling you what they're going to do there between the lines?
That basically, if they're going to continue to see robust profits, and you saw a similar thing from United, that they're not going to downgrade their full year forecast, they're going to maintain it. Does that mean that they are going to pass it along? We saw yesterday United cutting the number of flights that it was going to be operating domestically out of Newark, in part because there was less demand, so you just reduce supply and increase prices. I mean, are we going to see this kind of activity rather than actually seeing the discounts?
So are we getting lower fares or not? Because I thought we were getting lower fares domestically.
There was a story in the Wall Street Journal talking about $20 fares. I couldn't find them. I quickly went online and quickly looked for a couple of different routes that I personally was interested in.
And your line, not theirs, was that these are cities that people don't want to go to.
No, it's not their line. That was your line trying to infer what I was implying. But I'm just saying the less popular routes.
Okay.
That's
another way of saying cities that people don't really want to go to.
Well, there isn't, okay, moving on. There is a question here of some of the domestic cities and the routes there, whether it's, the mid states in the U.S.
Picking on Ohio a lot this morning, weren't you?
I'm not.
If you're just tuning in, you missed that. Picked on Ohio a lot in the last couple of hours.
Really, you're just trying to start trouble. You're just trying to distract me.
Maybe my Senate seat might be in Ohio. Maybe not. Futures right now on the S&P.
Where are
slightly
we going
softer,
with this?
Negative 0.25%. TK's away.
So we have to go.
Someone's got to go a little bit crazy, right? In the bond
Absolutely.
market, yields a little bit lower by a couple of basis points here. 423.61. We've seen quite a move over the last two sessions. 16 basis points higher across Friday and Tuesday. Underpinning that move, tons of supply from the credit market. I'll speak to Amanda Liner with Goldman Sachs about that at about 9:30 Eastern time. But also, you can't overlook this move we've seen in crude. We're talking about a 20% move from mid-July to where we are right now. Just a bit softer on the session to 86.45. Right now on Brent, Lisa, 89.63.
And how much further could it go if you do have some sort of unilateral resolution from Saudi Arabia that they want to get prices higher? And it seems to be going through, and you don't have the SPR, the Strategic Petroleum Reserve, or what do you call it, the Strategic Midterm Reserve?
Many people have referred to it as that, yeah.
If you don't have that potentially coming in as something, I do just want to say Cleveland to Orlando was one of the routes, and Detroit to Atlanta. That's according to a Wall Street Journal article.
I love how you keep
fares.
digging around this. I
Well,
think it's great.
it just raises this question, where are they? Because I was looking, for example, at routes to certain other places.
Places you'd like to go. Yeah.
They were a lot higher. They were still very expensive.
Okay. David Leibovitz is going to rescue you. Global Markets Strategist at JP Morgan Asset Management. David, it's good to see you.
Good to see you.
Thanks for being with us. Let's talk about that wrinkle in the soft landing dream. It's crude back towards $90, just south of that now, through that level yesterday. How much of a problem might that be for this rally that's really stalled out recently?
So I think that the problem it presents is that it creates a tension between the growth story and the inflation story that creates this tension for the Federal Reserve. And so on the one hand, we're going to see headline inflation, which is what central banks obviously target despite focusing quite a bit on core. you're going to see the headline inflation number begin to move higher. At the same time, you have these higher energy prices, you have the resumption of student loan payments, you have a savings rate that has dropped relatively precipitously, and we wonder if the consumer is beginning to bend, not necessarily break, but show some signs of weakness. And this, again, creates a tension for the Fed. They want to make sure that they get rid of the inflation that's been generated over the past couple of years, but they're trying to do so without causing a recession. So their job has become infinitely more difficult given this move.
Bear with me here for a second. How important is it what happens with those extra oil costs for the airline industries? In other words, if you start to see them pass it along to consumers, does that shift the conversation at the Federal Reserve in a way that it wouldn't if it started to eat into margins?
So I think the airlines are an interesting story because they've had pricing power all along, right? As people have begun to re-engage with services and kind of put goods off to the sides, the airlines have said, we've been able to raise prices and people are willing to pay. I don't know why you would change that in this type of environment. So I think that they're going to continue to raise prices in an effort to defend their margins, but that's going to create an inflation problem. And again, at some point here, the consumer is going to need to make that decision. Do they go on the extra trip or do they hunker down and begin to prepare for a more challenging growth environment?
Do you sense a shift, and we've been talking about that this morning, from this consensus around a Goldilocks and a soft landing to suddenly something more in the Neil Dutta and the Katie Kaminsky camp of, hold on a second, what if the Fed does pause? And then they have to hike rates again next year, and all of those rate cuts that are getting priced in are absolutely off the table. Are you moving to that side at all?
So I think what's interesting, if we take a step back, is that at the start of the year, everything was going really well. You know, Europe avoided a recession, China reopened and had a really good first quarter. The U.S. data was better than expected, and everybody kind of got this warm, fuzzy feeling that it was all going to be okay. What's happened more recently? China stalling out, Europe showing some serious cracks, particularly in manufacturing, and an inflation story that isn't really resolving itself the way that people would expect. I'm not sure that we have more clarity on, where we're going to be 12 months from now, but I think you're seeing investors begin to entertain the idea that maybe a soft landing isn't a guarantee, and I think that's what's causing market volatility to pick up here.
What I've struggled with this year, David, and we spoke to Steve Chevron about this yesterday. He said that when growth is scarce, you buy growth in the equity market. And I said, well, it's odd because we've had this growth rally year to date in the face of a series of upside surprises in the U.S. economy. What is that about?
So I think that, somebody actually said that exact same thing to me yesterday, and so I got to practice this conversation. But I think
because they listen to us, David, that's why.
Exactly. But I think, the issue here with buying growth in anticipation of slower growth is that we had the AI boom over the course of the past few months. And so valuation is way off sides. If these were 10 multiple points cheaper on some of the big names, we'd be more interested. But given where they're trading today, it's a very difficult case to buy risk assets at a valuation that feels extended when you see some potential clouds on the horizon. And so we're leaning more into value, more defensive names, the dividend payers, and a big part of that is the price that we're being asked to pay to hold those assets.
Well, are we looking also at energy companies that are really going to be coming to the fore and actually becoming more popular?
So energy, I feel like there have been a number of false starts over the years where people get really excited about energy and then it kind of falls flat on its face. I do think that, the underlying businesses from an operating perspective are in much better shape than they were, say, 5 years ago. And so if you get that tailwind of higher oil prices, you get that margin expansion, and you continue to have this focus on returning cash to shareholders, energy could be one bright spot, perhaps in the short to medium term. And I think that's what makes this market so difficult to figure out, right? We're talking about a slower growth environment potentially in 2024, but we're talking about energy companies and airlines that have pricing power. And so which side of the trade do you want to be on? Are we going to get the soft landing, and do you want to lean into that cyclicality, or do you see clouds on the horizon and maybe we don't want to play it a little
maybe these higher, longer-term yields are here to stay?
So what I would say is that the dispersion across the research community of Wall Street is nearly identical to the dispersion of views that we have internally. There are lots of people in very different places. I think what the Fed would like to see over time is a positive real yield curve that slopes upward. So I'm in the higher for longer camp. And I think when they do cut, maybe they go back down to 2.5. Is 2.5 really the neutral rate in the type of environment that we find ourselves in? I do think that we need to be prepared for an environment where rates stay higher for longer, but I don't think that's a bad thing. right? Interest rates, that allows markets to do what they're supposed to do, which is differentiate between winners and losers. And that hasn't been the case for the past 15 years. So this could be a better environment for value, better environment for active management, better environment for fixed income. You know, a world that maybe feels and looks a little bit more like the environment we were in prior to 2008.
So the bias is steeper curves?
I think so.
Okay, because we've just had a record, potentially. This came from Cameron Christ yesterday. 217 consecutive weekdays. In 06, 07, this yield curve was in inverted territory. Yesterday was the 216th. So today is 217. Can you believe it's been that long?
It is
It's
shocking,
kind of nuts, right?
especially considering the fact that people used to say, this is a sure thing for recession. Where is that now?
What do I read into that?
So I think this is the issue in the current environment. Right? We know all of the economic models broke during COVID. You know, forecasting is nowhere near as straightforward in this environment as it was prior to the pandemic. And so what you see amongst the investment community is just this very wishy-washy behavior where it's one side of the boat, then it's the other side of the boat. It's, 40% of professional forecasters saying we're going to have a recession that then doesn't materialize, and now everybody thinks we're going to have a soft landing. I think what we need to recognize is
changed 5 times this year.
Right, the unprecedented nature of everything that's gone on, particularly the fiscal response. We don't have a playbook for that because we haven't seen a fiscal response like the one we saw to COVID in decades, frankly.
David, thank you. This was great. David Leibovitz of JP Morgan Asset Management. Lisa trying to get you to disagree with Bob Michael in a very subtle way.
Well, hold on a second. He basically was saying that there are disagreements, and this
should have heard what Lisa was saying in the commercial break about people who take cruises.
Oh.
Same kind of people who take McDonald's on airlines. That's what you said.
That
Direct
is not
quote.
at all what I said, but you
Direct
know what?
quote.
You'd
go with that.
Let's just go with that one.
If you're just tuning in, welcome to the program. Your S&P 500 negative here by 0.2%. We're not meant to have favourites, but we do. Another favourite is Neela Richardson of ADP, and Lisa, she joins us in about 18 minutes' time.
I cannot wait to hear what she has to say in terms of those real gains that you're seeing in income. You mentioned that earlier, John, and I do think that this is one of the developments over the past few months that's really interesting and goes beyond just a temporary boost in spending because of what happened in the pandemic. This is really the question. If you get this could really prolong what we've already seen.
So all these headlines about cuts in tech, do you remember?
Yeah.
Over the last 12 months, and then just didn't see it show up really in the headline labour market data.
They were getting hired by everybody else. That was the whole thing.
Walking into other jobs, apparently.
Has that shifted? Because we did see that with the JOLT survey, which, by the way, everyone used to discount as completely imperfect and a completely non-scientific measure.
I know.
Back in the day, and now it's the key forward-looking indicator for what's going on.
Inflation expectations.
I personally, I enjoy that. I enjoy that.
Do you?
One. Yeah, I do, because it's so.
Have you ever had the phone call from you, Mitch?
I have not gotten the phone call.
I've never had the phone call.
Still waiting.
Do you know anyone who's gotten the phone call?
I don't know anybody who's gotten the phone call.
If you have gotten a phone call,
I'd love to hear from someone.
Please
if they've got
call
the phone
in,
call.
and we will patch you through.
Matt Miller writes in, 8 presidents come from Ohio. It's the most of any state in the nation. It's very upset with you this morning.
Okay, well, I look, I will just say, my father was born in Ohio. I have fun
that gives you the
Ohio.
right to, yeah, okay. Sure.
I'm just talking about routes of airplanes. This is from a story.
I'm told that's tied with Virginia.
For what? Oh, in terms of the presidents.
Yeah.
Ohio. It's interesting, though. I guess the swing state in between all the different things.
Is that what it's all about?
Rust Belt.
Uniting the country?
Yep.
Okay. Henrietta Trace of Vader Partners joining us next from New York. This is Bloomberg.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kid show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Today, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
As far as I'm concerned, the most important thing that the president is focused on is just trying to do everything within his toolkit to be able to get lower prices for consumers at the gas pump in the United States. It's really the price of a gallon of gas for the American consumer, not the question of which country's doing what here or there, that is going to be his ultimate metric for whether we're succeeding or not.
Okay, confused. That was the National Security Advisor, Jake Sullivan. I have no idea what all of that meant. Isn't the gas price higher in this country right now?
Right now it is, and they lowered it for a bit, and now it's going back up. It is.
So apparently
lower.
I shouldn't care what the Saudis and the Russians are doing. I should care about what's happening with gas prices, but gas prices are up, so shouldn't I care about it?
Okay, I was looking today at the prices, the AAA gasoline price level in the United States, and you could see that it is near the highest levels going back to later last year. It was higher, but still, this is unfortunate heading into a season that typically is not a driving season. We're going to get toward one. It could potentially shoot higher. Basically, they're trying to massage a message that is very uncomfortable for them right now.
Shouldn't you have been prepared to answer that question? That did not sound like an individual that prepared anything.
Have you seen any kind of cohesive remarks around the strategic petroleum reserves and what they plan to do, what levels are important to step in with? This has been a very tricky political issue for a long time, and now we're setting up for an election season where that SPR has been drawn down significantly, and it's unclear what levers you can pull other than to hope for a bigger downturn somewhere, but that's a sort of perverse hope to have.
Remember that fist bump?
Yeah. No.
That has worked out.
And we heard that there's going to be another fist bump, even though there's
I missed
some
that.
discussions.
When's that fist bump going to be?
Evidently, it's going to be in the next couple of days. There's going to be a G20 meeting between Mohammed bin Salman and President Biden.
I imagine they're not going to repeat.
I know.
That.
Kevin Book was saying that maybe they could.
Well, the Crown Prince probably should offer
this.
You know,
but then what if he offers this and it's not reciprocated? Then is it like game over and they cut
That's
production by another
awkward.
million?
If you don't do the,
I mean, honestly, like,
I can't believe we're having this conversation seriously for a start, but yeah.
Carry on. All right, let's move on.
Henrietta Trey's Director of Economic Policy Research at Vader Partners joins us now. Henrietta, we need to talk about the potential for a government shutdown. It's just not on the radar for people on Wall Street in a major way. Andrew Hollenhorst of Citi wrote this morning. Congress must act before the end of the month to avoid a shutdown. How avoidable is that shutdown, Henrietta?
I think the shutdown is quite avoidable. I've never really been in the camp this year that we're going to see a shutdown, mostly because I believe that Speaker McCarthy would look at the potential for a shutdown and realize that it's harder to turn the government back on than it is to keep it open. So I'm really concerned about the ability of Congress to create an off-ramp if they do shut down. And so I've gone back and looked. The longest shutdown on the books is 35 days. That was, of course, during the Trump 2018 to 2019 period. And that shutdown is basically what we would be trying to compete with. It's just for political purposes. It's just to sort of exercise demons and let air out of the balloon. And I'm afraid that it would have to be quite protracted. So I think that gives Speaker McCarthy quite a lot of impetus to reach a deal on a short-term agreement. That's what he's been socializing his members to for the duration of the summer, basically since late July, if I'm not mistaken. And so I think that what we'll see is a short-term kick-the-can sort of approach, which is, of course, what he did during the speaker's vote and then again during the debt ceiling negotiations. We're just prolonging the inevitable, which is the reality that Republicans do not have the vote for spending cuts at this time.
Dumb question of the day, Henrietta. Why is it that the House of Representatives isn't back in their seats until next week, even though the Senate's back up and running? And for the rest of the world, this is the week where the year restarts.
Right, exactly. So the Senate is up and running. They are ready to go, guns blazing, into 3 separate small spending packages. They have, of course, completed work on all 12 appropriations bills, which is the first time they've done that since 2018. Each measure is basically more bipartisan than the next. They are marching in lockstep, and I think a really important dynamic is to think about Minority Leader McConnell's health issues. He's going to want to demonstrate pretty remarkable competence right now, and I think that's going to give them a lot of incentive to move forward with, 89 and higher level thresholds on votes for those three small spending bills, plus the war in Ukraine supplemental funding request from the White House, which the Republican caucus in the Senate supports. And then the House is going to come back with just a litany of things that they're going to need to address. And they've only done one appropriations bill, so they're way behind.
At this point, we are heading into election season pretty significantly, and you could discuss it from the Republican side, which we have been extensively. But on the Democratic side, I'm curious how much of a headwind these higher oil prices that we've been talking about really are, considering that it was such a crisis last year when prices got to these levels.
What I've spent every election cycle looking at is when voters bake in their forecast for what the U.S. economy looks like. At the very earliest, you're talking about March, April of next year before voters start locking in their opinions of the economy. So right now, the potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time. Now, the understanding that inflation is high and gas prices are high is something that you see in the public discourse all the time, whether it's true or not. Right? You see, number one hit songs about how gas prices are high and the dollar doesn't get you to go anywhere. That is sort of baked in, but I don't know that this particular blip is going to be something that we need to overly stress about from the Biden camp.
Should we stress about the relationship or lack thereof with Saudi Arabia?
I mean, I think that you're going to see a lot of discussion of foreign policy, but Saudi Arabia is not going to be the number one talk. It's going to be China. And then after that, it'll be Russia and Ukraine. So I do think that that's occupying headlines right now. But foreign policy is notoriously one of those issues that American voters just do not pay attention to when it comes election day. Obviously important right now, important for investors, especially for gas prices. But when it comes to actual voting, that's not how people turn out.
Out of interest, and I think this is interesting, at the next debate, you're going to see a lot of candidates from the Republican side on the stage September 27th who have said and may well say again that they're going to declare energy independence and they're going to see more oil production in the United States of America. And that conversation is happening at a time where oil output in America is very close to all-time highs. Now, Henrietta, is that something that this administration chooses to celebrate, ignore, or whisper about?
I mean, they sort of walk that fine line. It's the same with the border control debate. More people have been arrested at the border than we've seen in years. So I think it's that very difficult dynamic for Democrats, which are a big tent party where you've got to work with environmentalists, labor unions, business interests, free market economy advocates, the business roundtable. I mean, they really try to walk the line. So I think they say different things to different audiences. And I would say, as I said before on your program, watch their actions. Watch what the administration actually does. To bring it back to China, where are the U.S.-China tariffs? Where are the Section 301 tariffs? Are they on at exactly the same rate as they were under Trump? They are. Are they likely to stay that way? Probably. So are you going to see various cabinet secretaries go over to China and try to, hold hands and start export control working groups and things like that? Sure. Are we simultaneously going to roll out export control restrictions that have never been seen before from the Bureau of Industry and Security? Yeah, we sure enough are.
Henrietta, just quickly here, I want to finish up. You mentioned unions and some of the push that we've seen from President Biden. Today, he is going to be discussing some of the avoidance of the warehouse and the shipping strike that didn't happen and celebrating the union over there. I'm curious, do you think this is going to be an effective push for him in terms of re-election?
I do think that getting the labor unions back in the Democratic circle is critically important. So you'll want to see that with steel workers. You'll want to see that with autos. You'll want to see that with dock workers. Any labor union they can speak to is where you see Ambassador Tai spending her time, Secretary Raimondo, et cetera. They are all trying to get as close as they can to as many labor unions as possible because, of course, that's where you've seen so much of the bleed into the Trump camp. Whether that's sustainable post-Trump is something that Democrats really want to try to avoid. So I do think that labor is top of mind for Democrats. always has been, and I know it is for very specific cabinet secretaries in that White House. I think that's going to be a sustained effort that they pursue, and you'll see that as a dichotomy with environmental groups for sure.
Henrietta, thank you for being with us today. Henrietta Trays there of Vader Partners on the latest in the United States, the politics of Washington, D.C. In the next hour on Bloomberg TV, here's the lineup. Barry Bannister of Stifel and why he thinks we've seen the highs already for the year on the S&P. Richard Bernstein of Bernstein Advisors on why he thinks you're going to see a rally in the cyclicals. And Amanda Lynham of BlackRock, a timely conversation here as we see an explosion in corporate credit issuance to kick off the month of September. Well. It's just a tease. It's just a
explosion.
Just trying to
coming.
Tune in, all of that good stuff.
I'm looking forward to it.
Thank you. From New York, this is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Well, we are looking at a little bit of softness, perhaps driven by this move that we're seeing in crude and concerns about what that means. Also seeing some weaker than expected data out of Europe, Germany in particular, lower by about 0.2% for the S&P, led by that crude level. This is Bloomberg surveillance, and all morning we've been talking about oil prices that had reached yesterday the highest levels going back to November. We heard from Southwest, we heard from United, we heard from Alaska Air. They are concerned about some of the increases in prices, and then Delta came out with their missive of the morning that had nothing to do with oil prices, with the CEO saying that Tom Brady, former star of all football teams, joining the airline as a strategic advisor. Bloomberg's Michael McKee is joining us for economic data. But Michael, do you want to comment on the fact that this
I thought I was your strategic advisor.
You're going to be the strategic advisor for my Delta travels.
If you want to fly Delta because Tom Brady has a contract to come in and give speeches for them, that's good investment for Delta.
It seems to be working, at least for some streaming networks. We are getting some data on the margins with some trade information coming in a little bit, I believe, lesser of a deficit.
Yeah.
What's the latest on that?
Negative $65 billion, but this is July data, so it doesn't incorporate the rise in oil prices that we have seen, but it comes in a little bit higher than last month, because last month was, or the previous month, put it that way, June was revised down to 63.7. So all in all, probably not a whole lot of impact on GDP, but we'll keep an eye on what happens in the months going forward, because oil prices are obviously going to make the deficit worse depending on how much we're importing. We also have headlines, Lisa, from Susan Collins, the Boston Fed president, who is sounding slightly more dovish than she has, saying that the Fed may still need to raise rates, but maybe not in September. Here's a quote from her speech, which is just breaking now. I expect we'll need to hold rates at restrictive levels for some time, and while we may be near or even at the peak for policy rates, further tightening could be warranted depending on the incoming data. Patience will give us time to better separate signal from noise as we assess available data and to balance risks as the effects of tighter policy continue to work through the economy. So she's not a voter this year, but she is a well-known economist, so I'm sure her words carry some weight. And she just joins the parade of people, including Chris Waller yesterday, saying that we don't have to do anything in September. And I think you're going to get the markets to that point pretty quickly.
Are there any hawks left on the Federal Reserve?
Well, Loretta Mester was out saying that she thinks we need to maybe raise rates again, but she's also not a September person, so necessarily, she says. So I think when we get the CPI next week, if it comes in as expected with the core dropping, then the Fed is pretty much locked into not doing anything in September.
John and I spent a lot of the morning talking about the conversation that we had with you, with Patrick Harker of the Philadelphia Federal Reserve, where he was saying that anecdotal data might serve a better guide at this point than a lot of the hard data that people traditionally look at, really highlighting why we should care about the Beige Book, which comes out today at 2 p.m. I always care about it, but other people might say it's really boring and not important to care about. Do you think that this will actually be more telling in terms of the real-time indicators of how much higher rates are percolating through the economy?
I think it will give us a better picture maybe than we've had recently. You'll get views from around the country in the different Fed districts, and that'll be interesting because, as you pointed out, Pat Harker said in the Philadelphia district, he's getting anecdotal reports from CEOs that things are slowing down. Is that happening across the rest of the country, and is that going to affect people like Loretta Mester, who thinks we might do a little bit more? What's the balance of strength in demand versus supply? Do we start to see it out of balance? I mean, it was interesting this morning. I saw some analysis of the Atlanta Fed GDP now, which is at like 5.6, 5.9%, and everybody says that's not going to happen. But we could get, it was Steve Stanley at Santander said, we could get 3.6, which would be extraordinary.
Before you go, I'm curious, Steve Matthews of Bloomberg News came out with this story today where he basically said that Fed officials are poised to double their growth forecasts on the heels of some of these better than expected prints. And in light of what we're seeing with, you can castigate it how you'd like to castigate it, but Atlanta Fed GDP now seems to show there is a robustness that had not been foreseen at any point over the past couple of years. What does this do in terms of the balance of the probabilities of how much they could potentially raise rates further down the line?
Well, it's too early to say that they have to raise rates more than another 25 basis points, which was their forecast. We'll get a new forecast on September 20th, but it does suggest that they have gotten the forecast for the economy wrong, at least through the third quarter. And if we get strong growth, it raises supply-demand questions and questions about whether we will see more inflation. But of course, the language that Steve used, double their forecast. Well, their forecast was for 0.5%. So if they double their forecast, they'll go up to 1%. And we were just talking about the possibility of 3.6. Then the question is what happens in the fourth quarter, because you've set a high bar, you've set a high starting point. And there are still people out there who are looking at this strong data and saying, yeah, but that means maybe even contraction in the fourth quarter because you can't keep rising at that rate.
I can't wait until tomorrow when we could talk about Barbie and Oppenheimer and how that boosted the beige book, particularly in Philadelphia, as well as Taylor Swift. Thank you so much, Michael McKee, as always. Joining us now is someone who always has incredible insights. We loved catching up with her over in Jackson Hole. Neela Richardson, chief economist at ADP, with a real insight into just how much ammunition, firepower a lot of the consumers have. And Neela, throughout the morning, John and I were talking about this real income increase that we're seeing across the board. And I'm wondering, from your perspective, how much is that going to fuel the next wave of consumer spending in a way that maybe isn't being fully appreciated?
Hi, Lisa. Good morning. Good to see you. Yeah, real wages going up is a great thing. It's a great thing for workers. But I think it's very important to provide context to that number because the thing about inflation, and I know this sounds very obvious, is that prices generally go up. But when it comes to core inflation, they don't come back down. And so we're still looking at higher prices from the consumer perspective. And where you've seen the wage growth is for predominantly low-paid jobs. And so that, by our estimate, is about $5,000 over the course of a year and a half of double-digit wage growth for this particular sector. $5,000 after tax doesn't buy a lot of eggs, oil, higher rent prices, and medical care. So you have to put this in the context of the consumer household budget as well.
It's really important to look at it that way, especially in light of what we've been talking about also this morning a lot, which is oil prices and gasoline prices, diesel, all of it heading higher and significantly so. How much is that going to crimp budgets in a more material way at a time where there already is heightened awareness of price sensitivity simply because of what we've seen and the levels that we've gotten to?
Oil prices going up, even for a short time, just complicates this narrative for the Fed, right? It's the one part of the economy we thought we've had under control, that higher oil prices wasn't going to spill over into transportation costs or goods production. But yeah, the specter has risen again. And so now we know even if the oil prices go down in the short term, they're always there, not quite asleep, and they could peak up. In terms of the consumer budget, we're back to school, we're back to work, we're back to commuting, and so those oil prices are not going to be something that consumers can skirt around, even if there's more remote work than there used to be.
And we were talking about this in light of some of the warnings from the likes of United Airlines and Alaska Airlines and Southwest saying that their energy prices have increased dramatically, which is not shocking considering what diesel has done. How much can they pass this along to consumers that already are starting to push back?
Yeah, that's tricky. Air flights have gone up. Consumers may have overdrawn their burst of revenge travel, and especially going into the fall, there's less of a holiday travel season. And so that's also a particular concern. Also, it's very hot, Lisa. I don't know if you noticed that.
I did notice that.
But in terms of energy cost, even late into September in much of the country, air conditioning is really driving up energy costs, separate from the airlines, but part of the overall consumer budget picture that allows for that wiggle room for travel. If you're paying higher energy costs at home, harder to make room for that last minute fall season travel as well.
Although I will say that recently, just anecdotally, talking about the beige book and anecdotes, I will say that going into stores, I've noticed that people are actually air conditioning less. And I wonder how much it's to save costs because sometimes you go in and it's still really hot. Anyway, I digress. I'm wondering, from your vantage point going forward, a lot of people are looking at Friday's jobs report and saying it was Goldilocks. It basically gave the Fed a free pass to remain on hold. And then bond yields rose. They rose on Friday and they rose again yesterday. People saying it was technical. People saying it's because maybe the Fed would pause and then there'd be a reacceleration of inflation. How would you describe the labor data that we've been getting, both from ADP as well as from the government, in terms of, is it really Goldilocks?
We're in a labor market that is, in some sense, Goldilocks. We're seeing wage pressures start to decline and moderate. We're still seeing solid job gains. But within that overall macro picture, it's a highly fragmented market. It's a market that has seen a lot of churn and continues to see elevated churn. And within all of that, there's a lot of inefficiencies. And so really, I think that the Fed's job now is much more complicated. When inflation was super high, it was easy to know what monetary policy was supposed to do. Now they're entering this period of fine-tuning, right? They're tweaking what the terminal rate should be. Maybe it's 25 more basis points, maybe it's 50, maybe it's a pause in September. There's all the spectrum of choice depending on what data you're looking at. If you look at the labor market, there is an argument to go stronger and there is an argument to pause. And it's just a matter of where you're putting the weight. Are you putting it on the unemployment rate? Are you putting it on wage growth? And that is going to be something that the Fed is going to have to feel out in all of this data.
What happened to all the layoffs, the white-collar layoffs that people were talking about a year ago?
They never happened. We see initial jobless claims are still quite low. And this is still a very solid labor market, even though the unemployment rate went up to 3.8% in this last report. It was because more people came into the labor market, not necessarily because companies were laying off. And when we look at our data, we see still solid growth across sectors, even sectors that have struggled this year, like manufacturing. For sure, services are still seeing strength. And so, yeah, if you're looking for bad news on the economy, I encourage you to look elsewhere because the labor market is not the source of it right now.
Which a lot of people are saying is the reason why there is going to be ongoing strength, and we are seeing the potential for the Federal Reserve to increase their growth expectations. Just to give you a sense, we get initial jobless claims, of course, tomorrow. And then I am curious, early next week, NFIB Small Business Optimism Survey, how much you start to see smaller businesses experience a little bit of stress or not in terms of anecdotal evidence. If you're just joining the program right now, you are seeing the S&P lower by about 0.2%, now 0.3%, deepening the losses ahead of the opening session. A bit of euro strength, a reprieve after quite a bit of weakness, 107.39, and 10-year yields lower, just a touch lower, 4.24% after yesterday, the sell-off that we saw in Treasuries. Neela Richardson of ADP with us here. And Neela, just on a personal note, I know that Tom is off. People are going back to school. Personally, I've got kids that are going back to school. Do you have a sense of whether the whole back-to-school spending is going to be as robust and, fruitful for the stores and less so for the parents as people had expected?
On the consumer spending front, just generally speaking, we've seen consumer spending stay strong, but there's caveats around that in terms of excess saving that was built up because of relief payments directly to households during the pandemic. It's starting to wane. We're also entering this period where there's higher interest rates, so putting some of that spending on your credit cards is going to be more expensive than it used to be. I think really what we're looking at is seeing through the fall and into that holiday shopping season where there's more optionality about what you buy. Kids need clothes for school, and you can change the labels, but it's hard to change the growing children in terms of new back-to-school clothes. But I think you get more discretion around the holiday shopping season. That's when 20% of retail sales show up in the economy. I'd be really curious to see how those higher interest rates bite that consumer spending.
Neela Richardson, always a pleasure, of ADP. Thank you so much. It is not an option to buy your growing children clothes. I just learned maybe what kind, but maybe not. Maybe the holidays will be the time when we can start cutting back. Coming up, George Ferguson, senior airline analyst for Bloomberg Intelligence, on some of the shifts in oil.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history.
Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Gary Gensler's decision of sort of engaging this regulation by enforcement, rather than getting clear laws. He knows they're not clear. He just likes that lack of clarity so that he can go after anybody and make up the rules as he goes along through bullying. And that's not the American way.
That was Chris Larson, Ripple co-founder and executive chair, speaking with Bloomberg's Ed Ludlow. You can hear more of that later today at Bloomberg Tech, 12 p.m. in New York, 5 p.m. in London. We have been talking all morning of the airline industry and their response to higher energy prices and higher prices just in general for labor, as well as just generally the operations. What does this mean for prices? What does this mean in terms of potentially waning demand heading into the fall and winter season? George Ferguson joining us now, senior airline analyst for Bloomberg Intelligence. George, what do you make of the announcements and frankly the synchronized announcements from Southwest, United, Alaska Air about higher energy prices and not necessarily factoring into profits this year?
Yeah, so, you know, we were actually refreshing our models yesterday and been watching fuel prices during the end of the summer. And, you know, they were creeping up and it was kind of becoming clear that there was no way they were going to make, I think, consensus earnings for this quarter. So I think the announcement is part of, you know, these companies trying to start to warn the markets that things aren't going to be good as we all thought. I mean, really, you know, coming out of second quarter, earnings were pretty good, especially for the full-service carriers, you know, especially for United, American, and Delta. And we really thought it would be a great third quarter for them. And fuel prices, right, have come up about 50% since then, really crept up on them. And pricing power, I think a lot of the tickets were probably already locked in because they were sold for summer. They were leisure travel, which typically has a longer lead time. So I don't think there was much room to move on fares. And like I said, we've been sort of busy looking at our models again, taking a lot of the numbers down. And I think this was trying to get to the markets to focus on it, that, hey, things just aren't going to be as good in 3Q.
So in other words, you think that the reaffirmation of full-year forecasts from United and a similar kind of tone from Southwest is not totally accurate, and that this is the first step to actually downgrading some of the earnings?
Well, so I mean, I'd be surprised if the full year can hang in there if fuel prices stay here. I just don't see pricing power for the airlines right now, right? I think when we again look at our models for 3Q, really what we're seeing is we think yields are slipping, which is, you know, synonymous with fares. We think it's been a very leisure-driven recovery for the airlines. It's been a leisure bounce back. And so we just think that strength in fares can't continue into 4Q. We don't see business travel coming back. And so I just have a hard time imagining with the setup we have right now and higher labor costs for the full year to be able to hang in there.
How many of the airlines have actually hedged oil prices?
Not many, right? So the only ones that really hedge oil prices, Southwest has a decent hedge, so they've been hurt less. We see small amounts of hedging at Alaska and JetBlue, and the rest just don't hedge.
When you talk about the softening demand, there was a story that I was reading about, a number of stories, about how prices are starting to go down in airlines, even reaching 2019 levels, particularly domestic flights. And that's one characterization. How much is this isolated to domestic travel in the United States? And how much is this a broader softening that extends overseas?
I mean, so if you're talking about U.S. carriers, I think that a lot of them built in pricing, you know, again, for this summer. Everyone I talked to went to Europe, I think, for vacation this year. So I think everybody saw the strong dollar and booked their overseas flights. And that's why I think, you know, 3Q looked better for the full-service carriers, because a lot of those tickets had already been sold. I think once we get past the summer season for the U.S. carriers, that long-haul demand just isn't going to be there in the strength that it is right now. And so I think fares will absolutely soften there. And like I said, we've already seen the domestic starting to tail off. I think that some of the domestic consumers not as well heeled. They couldn't afford to pay the higher prices. And in 3Q already, we had the airlines starting to warn us about yields and they're seeing some weakness in that demand. I think overseas, for overseas carriers, when we talk to people in Europe, I think a lot of the even the European carriers were seeing their demand from U.S. consumers. One of the interesting things I've heard from I think European travelers is the cost of dinner in New York is really expensive, so there's not much value for coming to this side of the Atlantic. And I think that was putting a bit of a damper on demand when it comes to, you know, long haul out of Europe. Again, I think the U.S. consumer was holding up a bunch of that. Asia's still reopening. Asia fares are really high, but capacity is starting to leak back into that market. And I think fares will come down to Asia, but the capacity constraints right now just keeping fares.
I love it, George. All the trash talking on both sides of the Atlantic. On one hand, it's so expensive in New York. On the other hand, have you seen how crowded the Uffizi is? I mean, honestly, you're getting out on both sides. There is a question, though, George. You did say that you don't see business travel returning. We have heard that it has been coming back and that people are going back to the office. What's the latest in the thought process around what comes back and at what levels? Is this really just an issue of people not traveling or companies not shelling out for business class?
Yeah, so, you know, it's always, this is a hazy part of the market we always sort of probe through, try to figure out what's really going on. I think that with return to office coming this fall, it seems like at least some industries, especially the financial industry, pushing a little harder to get people back in the office. I think that's going to improve, you know, business demand. We've still seen it between sort of 65 and 75%, so it hasn't fully returned. Some interesting anecdotes we hear from the field is like, you know, the consulting industry. Consultants just not going and working on site anymore, working from home, right? And so some of that may be because people aren't back in the office, so why bother bringing the consultant back? Consultants are a big part of, you know, airline spend. So I think once we start to see a return to office, then I think we're going to figure out if something like the consulting industry follows suit, goes back to working out of the out of companies, you know, premises. But I mean, you can imagine that if there's an economy there, if you know, if the consultants go to companies that they're working for and say, if you don't want the consultant in your office, it'll save you some money. We may never see, you know, sort of business travel get back to 100% of what it was in 2019. But again, look, things morph, and so there'll be other business travel that backfills. But I still think we've got a bit of time before we get back to even 80–90% of 2019 business travel.
Before I let you go, George, I do want just your take on a controversy this morning on Bloomberg Surveillance about why certain routes by certain airlines have been increasingly discounted by certain airlines. There was this story in the Wall Street Journal about $20 fares from Cleveland to Orlando, from Detroit to Atlanta, flights that are as cheap as $115 from Mexico to Central America. Why do airlines discount certain routes more than others?
It's all about competition, right? And so, you know, I think everybody likes to think that United and American Delta full of business travelers, Spirit, Frontier full of ultra low-cost leisure travelers, but there's a mix inside of every airplane, except for business travelers in Spirit and Frontier. And so, you know, if Spirit and Frontier show up, for example, in your marketplace and you're Southwest or United, and you feel like they're hurting fares in that market, you may abnormally lower your fares to even loss levels just to try to drive them out of your marketplace. It's all about competition.
Any travel coming up soon, George?
Yeah, I'll be over in London for International Society of Transport Aircraft Traders. Always a great conference in the beginning of October.
Well, we'll catch up with you on your experience traveling there, as well as what you gleaned. George Ferguson of Bloomberg Intelligence, thank you so much for being with us. Coming up on Bloomberg TV at 2:30 p.m. Eastern, Armen Panosian, new co-chief executive officer of Oaktree Capital, at a time where there is an increasing amount of money going into private capital. This comes as there is suddenly a renewed appetite by companies to sell debt. We are getting word of yet another debt sale on the slew that we saw, the barrage of corporate debt sales yesterday that some people say was kicking around the Treasury market a significant way. There's a $3.7 billion debt offering for the Syneos buyout coming out. So it's not just investment grade, it's also high yield. Some $40 billion of debt sold yesterday. The expectation is it could surge to the highest level this week, certainly of the year, if not for quite a bit of time, as companies start to grapple with how we deal with higher rates for longer, whether we lock them in. Right now, we are seeing crude come down after yesterday hitting the highest levels going back to November. We are seeing that cut from Saudi Arabia, from Russia, percolate into this feeling that maybe the U.S. and frankly the China economy as well isn't as weak as people previously thought. Today a little lower, $86.31, but still substantially north of that $80 front on crude traded on the NYMEX. We also are seeing yields basically going nowhere, 4.24%. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports. The week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Live from New York City this morning. Good morning, good morning. Your equity market slightly negative here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, more Fed officials putting rate hikes on ice as Asia pushes back against dollar strength, and crude sitting near the highs of the year. We begin with the big issue, a new challenge to a soft landing.
When you look at the broad commodity market,
commodity prices are rising.
Higher oil prices, the spike in oil prices and gas prices.
Crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
That tends to be something to follow as a catalyst into where you start to see inflation numbers tick up.
Pressure on inflation.
The last thing consumers need at this point in time.
It really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%.
You probably saw the two weakest prints you're going to see this year over the summer.
If we are seeing higher commodity prices, eventually that should translate into higher yields.
We're going to see higher yields for a little bit longer.
The reality is that it's very, very difficult to achieve a soft landing.
There's so many wrinkles right now.
There's definitely some fraying around the edges.
Bad news might wind up becoming bad news as we move forward from here.
Crude very close to 90 in the last 24 hours, a break at that level for the first time since November. Joining us to discuss, Stifel's Barry Bannister, Richard Bernstein of RB Advisors. Barry, your words, you say new highs in stocks, exceptionally unlikely. Barry, can you give us the why?
Yeah, if you look at the broader stock market, the valuation is very high. The price-earnings ratio, the way we calculate it, versus the financial conditions index is high. The stock-to-bond ratio looks high to us. And the earnings estimates for 2024, the street, 9% earnings growth. Our model comes up with about half that level of growth, about 4.5%. So overall, we've had a great run through mid-2023. We've been saying since the summer that the stock market would be flat in the second half as it digests the recent gains, and we have some uncertainty looking forward.
Richard Bernstein, do you still believe the outlook for profits is actually bottoming here?
I do, John. Our data, our models actually are suggesting that we're starting to look at profits reaccelerating, which I think is very important, and very important for something that you didn't even mention in the preamble here, was that the labor market is still pretty tight despite a profits recession. Now we're going to see profits start accelerating. Corporations usually hire as profits start accelerating. So I think to expect the labor market to start easing when profits are reaccelerating may not be the right tack to take here.
Barry, what's Richard getting wrong?
Well, if you look at, for instance, technology, where our earnings estimate is below the street by a more significant margin, earnings are a lagged effect of the slowdown we've already had. In other words, the durable goods, the factory orders, the PMI indices, they all slowed down in 23. And what you find is there's a lagged effect. And we've gone back 30, 35 years historically, best fit. There's a lagged effect to the economic variables. So we have to be cognizant that we have seen a fairly significant slowdown in some of the cyclical economic data that will filter through at least through the first half of 24. And getting through the first half of 24 is a very long time to wait to be right about a reacceleration.
So, Richard, where are you seeing that reacceleration in profits right now? Where are you expecting to see that in this equity market?
Well, it's already happening, John. I mean, this is not something we have to wait for. It's already happening. Profits growth is troughing. And in the United States, profits growth is troughing in many parts of the world. I mean, I don't think people realize that European earnings are growing faster than the U.S. technology sector's earnings. So, you know, I don't think we have to wait for this. It's already happening.
So, Richard, the small caps, international, what's the bias for you?
Right. So, John, I may sound like a broken record here. I still view the equity markets as being like a seesaw. And on one side of the seesaw, we've got tech, we've got all the sexy stuff on one side. And on the other side of the seesaw, we have everything else in the world. And so our firm is squarely planted on the everything else in the world side of that seesaw, and small caps are clearly playing a role in that. I mean, all you have to do is look at the relative price between the NASDAQ 100 and the Russell 2000. I mean, it's an historic gap, but yet earnings growth is starting to trough, which usually favors lower quality and smaller companies.
I wanted to pick out a quote that you'd put in your research, Richard. The quote reads as follows. I'll share it with our audience. The performance of the Magnificent Seven versus the Russell 2000 continues to stretch. We should all hope this doesn't continue because the implications for the U.S. economy are dire. Now, is that hope or a strategy? Richard, which one is it?
No, I think that's actually what history would suggest. John, when profits growth troughs, markets become very Darwinistic. It becomes survival of the fittest. And so that's why you get broad leadership at the beginning of a cycle, narrow leadership at the end of the cycle, because more and more companies fall by the wayside as the cycle matures and they can't keep up their earnings growth. If you believe that there are only 7 growth stories in the entire world, that is an amazingly dire economic forecast. So my argument is that we should all hope that the Magnificent Seven underperform, because if they do perform, and if that's correct, let's say it's not a bubble, I kind of think it's a little very speculative, but let's assume it's not a bubble and it is fundamentally based, that is a tremendously dire forecast of the future. We just can't believe that the global economy is in that shape, that there's only going to be 7 growth companies in the entire world.
Barry, do you hope the Magnificent Seven will underperform, or do you think the Magnificent Seven will underperform?
Look, the cyclical growth, which includes the big retail, the Tesla, as well as all the big tech, is about half the market, 45%, if you just take all of cyclical growth within the S&P industries. So if they underperform, the market's not going anywhere. And, you know, what I have to do is predict not only the market level and direction, but the winners within the industries. And for the sake of argument, let's say we are reaccelerating in a very significant way. The real 10-year TIPS yield should be well north of 2. It was 2.5 before the financial crisis, 3.5 before the tech bubble burst. So let's say it's 2.5. If you overlay the price of oil, Brent oil, against the 10-year break-evens, it should be 2.5. So what are you looking at? 5% on the Treasury yields. We're not going to maintain a 21 forward multiple of earnings at a 5% nominal Treasury yield. So the point is, the stock market is a financial instrument. If you're going to talk about very bullish outlooks for economic growth, you're also going to have a lower multiple for it.
Richard, what would you say back to that?
So I don't disagree with what Barry just said. I think the market overall is on the expensive side for sure. There's no doubt about that. But I think I have to remember, Barry said this, that what's important is the construction of the market. You know, in the first half of the year, the Magnificent Seven contributed about 70 to 75% of market performance. So if you're saying the market's overvalued, if you're saying the market's going down, one's implicitly arguing my seesaw combination here that the Magnificent Seven underperform and other parts of the market are likely to outperform, with the fulcrum of the seesaw, kind of what Barry's referring to, basically doing nothing. And I think that's a fair assessment.
Richard, away from stocks, developments in the bond market, yields up again over the last couple of days. We'll talk about some of the corporate issuance in the credit market a little bit later this morning with Amanda Landham at Goldman. We'll do that about 9:35 Eastern time. But yields up, driven in some part also by this move in the crude market. Big rally for WTI, 20% move since middle of July. Richard, we've seen a couple of airlines, 3 of them actually this morning, United, Southwest, Alaska, all talk up higher fuel costs. The conversation we had on the program a little bit earlier this morning is whether these airlines need to eat that or whether they can actually pass that on. Are you confident they can pass some of this on?
I think they're going to try, for sure. I think that's what most corporations do at the beginning. But John, I think your opening statement, the preamble here, was really important because it started with saying the Fed's on ice, but then it was all about commodity prices. I think if we ever needed to understand that the Fed is a lagging indicator, your preamble said it perfectly, that the Fed is thinking it's time to pause as commodity prices are starting to go up and companies are going to try to pass that along. I think that's a perfect example of why the Fed has always been a lagging indicator.
Well, there's some real tension here, Richard, isn't there? The Federal Reserve potentially rate hikes on ice in September. At the same time, you're seeing iron ore at the highs we haven't seen for about 4 months, crude at the highs we haven't seen since November. All of this is happening as China seems to be slowing down. Can you make sense of that for me, Richard?
Well, I think, John, I think we've got to be a little careful on jumping on the China stinks bandwagon. I think that we're kind of looking at a situation where the government there, both the central bank and the fiscal side, is not giving up the stimulus battle. And so, in the United States, we would always say, don't fight the Fed. I think one wants to be a little careful from an investment point of view to say you don't want to fight the PBOC and the Chinese Central Command or however you want to phrase it. So I think we want to be a little careful. Their economy is not falling off a cliff. It has been stumbling. It's disappointing. But, their economy is going to reaccelerate.
You mentioned the Federal Reserve. I hear Mike McKee. So let's get to Mike McKee. Mike McKee, rate hikes on ice this month.
It's beginning to look that way. A lot of members of the Open Market Committee have suggested they could take a pause. But, heck, we went to the mountains, we went to the beach this summer, and we kicked the can down the road on a lot of possible problems for the economy ahead, one of which you've been talking about a lot this morning, oil prices. You were talking about jet fuel, but what does it mean for gasoline and consumer confidence? The stronger dollar, it keeps getting stronger, which means probably we have fewer exports, but we also have lower inflation. Stronger U.S. growth. We were talking about an over 5 handle on the Atlanta Fed GDP now. Some people are saying that's ridiculous. We probably won't get more than 3. 3% would be 3 times what perhaps the potential growth is right now. Some problems solve themselves. All things China. We're going to be looking to see, and you've been talking about it on this show already, what happens with the Chinese economy and what impact that has around the world. Government shutdown. There's a self-inflicted wound coming up at the end of the month, it appears. And then labor unrest next week. Same day we get CPI, we get word on whether the UAW will send 150,000 workers out on strike, which will also shut down suppliers and things like that. So a lot to worry about, or not. Here's the gasoline price situation. Everybody's going to be talking about the impact of these higher oil prices on gasoline, but take a look. Gasoline prices are going down, even as oil prices are going up. It's that time of year when demand is slower. We've got all those refineries that were out back in service pretty much. So where do gasoline prices go? We don't know. Makes it very difficult for the Fed. Now, for September, they're kind of putting things on hold. But November, well, we heard from Susan Collins this morning. She said, patience will give us time to better separate signal from noise as we assess available data. And I'm going to quote the eminent physicist Niels Bohr, who once said, prediction is very difficult, especially if it's about the future.
Well, Niels Bohr nailed it, didn't he? Mike McKee, thank you, buddy. As always, Mike McKee there on the Federal Reserve. Barry Bannister, Richard Bernstein are going to be sticking with us. Your equity market on the S&P 500 here, negative by 0.2%. I'm happy to say we can get you some movers going into the opening bell. Here's Abby.
Indeed, John, and we are looking at the possibility of a second down day in a row. Mild losses right now for the S&P 500 and the NASDAQ ahead of the open, but one stock that is soaring going against that grain, Roku. These shares are up more than 10% the last time I took a look, given the fact that they are planning on cutting 10% of their workforce. They're consolidating some office space, and excluding the charges for those restructuring moves, Roku raised its third quarter revenue guidance by as much as 7%. So investors excited about that. Block, on the other hand, down 2.7%. UBS has cut the shares to a neutral from a buy on a potential slowdown in gross margin profit growth. And John, they're talking about a softening consumer discretionary spend going forward. You were mentioning those airlines. Well, Southwest Airlines in some ways confirmed that, saying that they have seen some luxury travel down in the month of August. Apparently the Labor Day weekend was strong, but those high rising fuel costs, well, what is that going to mean for the airlines? We'll be exploring that more after the bell.
Looking forward to that conversation in about 17 minutes time. Abby, thanks for that. Equities a little bit lower then, down by 0.25% on the S&P 500. In the bond market, yields pretty much unchanged on a 10-year over the previous 2 sessions, a 16 basis point move Friday and Tuesday. A curious move. Was that all about credit supply? We'll have that conversation with Amanda Lynham of BlackRock a little bit later this morning. In the FX market, the euro right now, slightly positive at 107.31, positive there by 0.1%. The story, though, over the last 8 weeks, dollar strength. Coming up, Asia pushing back against a surging US dollar.
They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. They don't really want the exchange rate to be another source of instability.
Japan pushing back with some verbal intervention, China pushing back as well. That conversation up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
City, London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. The Chinese authorities have the capacity to manage some weakness. I don't think they need to be too afraid that all of a sudden the yuan is going to drop precipitously.
The US dollar heading towards an 8th consecutive weekly gain, sending Asian currencies to multi-month lows and prompting authorities there to push back with threats of intervention. Japan issuing its strongest warning in weeks, saying the nation is ready to take action amid speculative market moves. And in China, the PBOC escalating its defense with a record one daily fixing. Bloomberg's Ender Curran joins us now for more. Ender, I mentioned this a little bit earlier. Talk is cheap. Is that talk going to work?
Well, the problem for the authorities in Asia, John, is that this is not a story about the yuan or about the yen. It's all about the US dollar. And as you know well, the conversation here is that the Fed may not yet be done hiking, and even if they are, interest rates are probably going to stay high for a while, and that's what's driving the dollar higher. So it's well outside of the control of what's happening in Asia. The yuan fell to the 2007 low that you mentioned. You might on paper say that's because of the China slowdown, but as I'm saying, it's as much a dollar story as anything else. And of course, over in Tokyo, the authorities there warning against speculative moves that they might have to step into the market, but they're going to have to step in, of course, against the Fed freight train. But it is another example of how the Fed's hiking cycle and the dollar is causing pain around the world, and surely it will add further fuel to the campaign that's led by China and other nations that want to diversify away from dollar usage.
And out of interest, what are they worried about? Because Japan are telling us they want to reset inflation expectations higher. Surely a weaker currency helps that. China's going through some economic difficulty. We spoke to a lot of guests, including Alan Ruskin this morning at Deutsche Bank, about the potential of actually a weaker currency helping them. What don't they like?
Well, a weaker currency, there's a question of diminishing returns when it comes to trade and exports, when demand for trade and exports is already weak, John. I think that's part of his thinking there. But also I think it's more about volatility and the pace of the drop or the pace of the decline. Certainly Japan has always leaned against large gappy type moves in the yuan. And on the Chinese side, of course, they don't want the yuan falling at a pace that might trigger or pressure companies and households to try and get their money out of China. Remember the whole capital outflow story that we experienced back in 2015. So I think on the one side is quite a debate of diminishing returns when it comes to what kind of lift you get for trade, but on the other side, it's the danger from too much volatility in your currency market.
Anna Karen down in Washington, D.C. on top of the story. Pushback from China, pushback from Japan. Back with us for a final word. Barry Bannister, Richard Bernstein. Barry, we need to talk about the other side of the trade. 8 weeks of gains for the dollar. Longest weekly winning streak potentially going back to 2014. I remember those conversations 10 years ago, Barry. We used to talk about it. Is that strong dollar good or bad for the S&P 500? Barry, is it good or bad?
Well, typically a strong dollar is disinflationary, and so it's good for the tech stocks. But in this case, the Fed is really doing a pretty good job of breaking the world. You know, the Chinese are pretty close to deflation. So in what you call real effective exchange rate terms, the yuan nominal and real seem to be going in different directions. The Japanese are having to repress their currency. And so the Fed is, with its rate differential, keeping the dollar aloft. It would be, I think, favorable, though, if we get some relief on inflation, for the Fed to back off a little bit and for the dollar to come down. I think it would be a positive, of course, for earnings, but for other things as well.
Richard, would you agree?
So, John, I think the most interesting thing is the first half we were talking about commodity prices, and the second half here we're talking about an appreciating dollar. Normally when the dollar appreciates, commodity prices go down. This time we're talking about commodity prices going up at the same time you have an appreciating dollar. That says somebody out there is demanding commodities, that the price increase of commodities is not curtailing demand. And the price is still going up despite a stronger dollar. So I think overall it suggests that people shouldn't think that the global economy is falling apart here. Somebody out there is demanding commodities, whether it's China, whether it's who knows who, but somebody out there is demanding commodities, and the appreciation of the dollar isn't stopping it so far.
If it was just crude, I'd say, Richard, maybe it's just a supply story, Russia, Saudi, but it's not just crude. To your point, it's also iron ore as well. So,
Correct.
Richard, with all of that in mind, final word. Let's put some money to work. If the international story is not as bad as people say it is, and you're indicating it might not be, where do you want to put that money to work right now? Where specifically, country, sector, index? Pick whichever one you like.
So, John, we have our lowest weight in the United States we've had in the history of our firm. We're overweight Europe, as I mentioned before. European earnings growth is surpassing that of the U.S. tech sector, and that's expected to continue as we go into 2024. Japan, the weak yen is an interesting story. We'll see if that continues, given some of the discussion we've just had. But that's critical in terms of the Japanese story. Even China, with the amount of fiscal stimulus they've had. I mentioned small caps before in the United States. We think that's interesting as well. It's basically everything outside the sexy stuff on the one side of my seesaw.
Richard Bernstein, Barry Bannister, to the two of you, I've enjoyed the last 20 minutes. Thanks for being with us. Appreciate it. 8 minutes away from the opening bell. Equity futures here, trying to stay to recovery. Just a little bounce off the low. We're still down here by 0.2%. Coming up, the morning calls, and later, September, kicking off with an onslaught of new debt supply. That conversation still ahead with BlackRock's Amanda Lynham. Live from New York City this morning. Good morning. Your opening bell, 7 minutes away.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Just a little bit of weakness to start the week. We're about 7 or 8 minutes away from the opening bow. Call it 5 now, actually. Equity futures pulling back just a touch on the S&P 500, down by, let's call it 0.2%. In the bond market, some big moves again. 2 sessions, Friday, Tuesday, 16 basis points higher on a 10-year yield. The 10-year right now at about 425.19, pulling back just a touch. How much of this move was about corporate credit supply? We'll have that conversation in about 10 minutes' time. How much of this move was about this right here, crude? WTI and Brent. WTI, 8-day rally at the close yesterday, the longest daily winning streak going back to January of this year. The overall price through 90 briefly on Brent for the first time since November. Across the board here, still near close to highs for the year. The dollar is just about negative, but the crude price is the one I want to focus on. Brent and WTI. Brent at about 89.72, WTI at about 86.50. That's the price action. Let's get you some morning calls. First up, UBS downgrading block to neutral, seeing limited upside as growth decelerates due to a softening consumer. Your second call from Morgan Stanley upgrading First Solar to equal weight, saying that shares deserve a premium. Given the lack of downside risk, that stock is positive by 1.8%. And finally, TD Cowen upgrading Constellation Brands to outperform, expecting the company's analyst meeting to serve as an upside catalyst. That stock is up by 1.7%. Coming up, debt issuers storming the market with a post-Labor Day bond blitz. That conversation up next with BlackRock's Amanda Lynham. Your opening bow just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Three seconds away from the opening bell here this morning. Good morning to you all. Equities pulling back just a touch. No real drama here throughout much of this morning. We're down about 0.2% on the S&P. On the Nasdaq, down about 0.25%. Plenty of disruption in the last 24 hours in the bond market. And in the commodity market too. We'll talk about that now. Switch at the board. There is your opening bell. Get to the bond market. Yields look like this. Lower by a couple of basis points on a 10-year, 424 over the previous two sessions. 16 basis points higher Friday, Tuesday, of course, closed on Monday. And that move, is that about supply coming out of the credit market or about this move in crude? 86.43 on WTI, negative here by 1/3%, but an 8-day rally on crude that we need to talk about a whole lot more over the next couple of days. In the FX market, the euro showing a bit of strength. The data out of Germany, ugly, but some hawks, two actually, going into the ECB a week tomorrow, flagging maybe the potential for an interest rate hike in September, just reintroducing just a little bit more two-way risk into that ECB meeting in Frankfurt, Germany. About 40 seconds into the session, we look like this. Equities right now on the S&P negative by 1/3%. On the Nasdaq, we're down about 1/3% also. One sector to watch at the open, the airlines, sounding the alarm on higher fuel costs due to surging crude prices. Southwest cutting its Q3 outlook right in this. August bookings were on the lower end of the company's expectations, modestly impacted by seasonal trends. Abby has more. Hey, Abby.
Hey, John. And you can see that Southwest Airlines down more so than United Airlines and Alaska, down more than 1%. In fact, down for a fourth day in a row over that time period, Southwest Airlines falling about 5%. So this filing that came out may not be a surprise to everybody. They also talked about the fact that they saw a weaker leisure travel in the month of August. To be fair, Labor Day better. They are expecting better trends as the year goes on, or solid trends. But this rising fuel issue, oil, WTI crude, up more than 35% from its low earlier this year, that really pressing into jet fuel. So these three airlines highlighting the fact that that could really crimp their profits going ahead. Now, they have not actually adjusted numbers in that fact, except for, of course, Southwest Airlines, as you just talked about. They did tighten their revenue range. Now, it's really interesting, Southwest Airlines, because of the issues last December, I think we have to discount a little bit on the year. It's down more than 10%. United Airlines up more than 28%. But the group as a whole, John, this is really interesting. It's a classic inverse relationship between the airlines and that big cost component, oil. For the year into the peak back in July, up more than 43%, now down 30% from that as WTI crude and Brent crude oil has gone higher. And right about now, even the airlines up about 10% on the year. Crude oil up just a little bit more, up 14%. It seems that the balance is tipping in the direction of commodities despite that dollar strength.
Abby, thank you. Southwest right now down a little more than 2%. A note on the airlines from Bank of America, remaining cautious on the airline sector, writing the following. Commodity prices have created meaningful earnings volatility this year. Pricing power could weaken as the recovery normalizes and capacity comes back online. As a result, our new earnings estimates result in lower price objectives across the group here. This is a call across the group for the entire airline sector. The latest there from Bank of America. I want to turn to big tech. Shares of Apple under pressure. Chinese government agencies have banned staff from using iPhones at work, according to the Wall Street Journal. It isn't clear how widely the orders were issued. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Apple is softer by 0.6%. The Wall Street Journal reporting that some central agencies in China have issued directives via chat rooms and in meetings that they should replace their mobile device in the event it is a foreign device, not just an Apple iPhone, but a non-domestic device. I would say, remember that Bloomberg reported in May of last year that Beijing offered a 2-year deadline or term limit for state corporations and indeed government agencies to swap out their foreign brand personal computers for a domestic brand. So this is not necessarily an unprecedented move. Apple now soft at 0.8%. Apple have not responded to a request for comment from Bloomberg News on this story, but it's interesting timing given what we've discussed in the last few days about Huawei's Mate 60 Pro. I would also point out, John, that the European Union published its gatekeepers list under the new digital services law that we were expecting. As expected, the Apple App Store was listed under it, but interesting that iMessage may be exempt, and the EU is probing that. So that may also be a factor as Apple shares are down 0.9% now.
Let's stay on China, Red. Does this raise questions about the new iPhone being launched in the next week or so?
Yeah, I mean, China is still a critically important end market for Apple. It is its biggest international or overseas market beyond the United States. You and I always discuss following the launch of a new iPhone generation what the big drivers are of it, and the Chinese middle class is always a part of the conversation that you and I have. That said, you know, I'll be at Wanderlust on September 12th next week. I think there's high anticipation that the hardware upgrades to this generation iPhone are substantive enough that they will do well broadly. And despite all the geopolitics and headlines, you know, Apple, remember, was quite bullish on their performance in China in the quarter just gone. While the US smartphone market saw contraction, China grew.
Ed, thank you, mate. The stock is down by about 1%, 5 minutes into the session, pulling back just a touch here by 0.4% on the S&P 500. On the Nasdaq, down a similar amount. We're negative by 0.37% on the Nasdaq Composite. Turning to the food sector, Albertsons rising after a Bloomberg scoop that the company, along with Kroger, is selling stores to C&S wholesale grocers and SoftBank to help with their $25 billion merger. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Albertsons currently up about 1.8% on the heels of that Bloomberg scoop that C&S, with, of course, backing from SoftBank, is in talks to buy most or all of the grocery stores that Kroger and Albertsons are looking to offload here. That's according to people familiar with the matter. So rewind here. Remember that Kroger agreed to buy Albertsons in that $25 billion deal last October. The end product, of course, would be a U.S. grocery giant with nearly 5,000 stores. And at the time, to soothe those antitrust concerns, the company said that they would sell up to 375 stores, which brings us, of course, to today. And it's not clear so far how many stores C&S would be acquiring or how much they would pay for them. But according to this Bloomberg scoop, that deal could be announced as soon as this week, John. So watch this space.
Stock is up 1.6%. Katie, thanks for that. Let's turn to earnings. Roku raising its third quarter revenue forecast and cutting 10% of its workforce. We determined to implement additional measures to bring down operating expenses by consolidating office spaces, slowing headcount, and limiting new hires. Isabel Lee has more. Hey, Isabel.
Hey, John. Investors are definitely liking that news because the stock is up around 14% for today. And the company also raised its guidance to between 835 to 875 from 815. So that's a massive increase. And Roku is among the tech and media companies that have earlier this year faced prospects of weakening sales as advertising pulls back. And the company last year warned its investors of a tough economy ahead. In March, it also cut back some 6% of its workforce. And this is the second time this year. But because of this recent update, it seems like it's going to be good news for the stock moving forward. We have Bloomberg Intelligence saying the outlook suggests revenue gains are reaccelerating and the job cuts should help overall profitability. And we have Piper Sandler, for its part, raising its price target to 90 from 70, John.
The stock likes it, up almost 14% there. Isabel, thank you for that. Isabel Lee there on Roku. That stock higher to 95.23. The broader market looks like this. 8 minutes into the session, we're negative by, let's call it 0.4%. Yesterday, more price action in the bond market to pay attention to. Yields higher by 16 basis points over the previous 2 days. Yields this morning on a 10-year lower by, let's say, a basis point or two to 4.24. Plenty of blame to go around, some for the commodity market, some for this. September kicking off with a flurry of new debt deals. At least 40 businesses tapping the high-grade debt market on Tuesday alone, with U.S. companies pricing more than $36 billion in new bonds, marking the busiest session of the year so far. BlackRock's Amanda Lynham writing, quote, a key implication of the higher for longer interest rate environment that we expect is an increase in performance dispersion across the corporate credit markets. I'm pleased to say that Amanda Lynham joins us now for more. Amanda, let's start with what's happening with supply currently. Are you expecting more of the same through the month of September?
Good morning, Jonathan. Thank you for having me. Yes, September is historically an exceptionally busy month for primary market supply. Over the past 5 years, it's actually been the busiest month in the U.S. high yield market. And in IG, it's also one of the busiest alongside March and May. So the significant uptick in activity that we've seen, it should be widely expected by bond market participants that have played in this market for a bit. It's just historically the seasonal pattern. I think there are two things, though, that are really important to watch. One is arguably for the high yield market, this is a larger test because we've been coming off of 2022 and year to date, which has been so low from a supply perspective. So it will be notable to see how the high yield market digests the wave of new issue activity that we expect for refinancing. You had noted that this, so far this week, while early, has been dominated by investment grade. And so I do think watching that high yield market, and we've seen some announcements this morning, how that flows through the rest of the month will be critical. And then second, you've been talking about it all morning in terms of, is the primary market activity the reason why there's been a sell-off in Treasury yields? And certainly there is a link in terms of, and this is mostly an investment grade phenomenon, if investors are buying a new issue and they wish to hedge the interest rate component, they will sell a maturity of the equivalent, or they will sell a Treasury of the equivalent maturity to kind of hedge out that interest rate risk and isolate the spreads. I think the issue, though, is that the activity we saw in the U.S. IG market so far this week has been heavily skewed to the front end. And I don't think in general that we can attribute it primarily to what's going on in the primary corporate credit market. I think there are enough cross currents, as we've all been following, to really attribute the volatility in the Treasury market to other things outside of corporate supply. But certainly there is a link. I just think that where the issuance has been focused predominantly in the front end, predominantly in single A rated IG issuers, I don't think that we can draw that link completely.
Well, there's two ways of looking at this. Either the people in the Treasury market weren't paying attention to the supply that was coming through, or Amanda, there's other things, and you've pointed to those other things. So let's talk about it. Those other things, what are the other things you think we should be focused on?
Well, certainly the higher for longer narrative, we can't seem to close the door on that completely. And I think that's probably appropriate. The rally in commodities and crude in particular in recent days has kind of added further fuel to that. We've seen certainly announcements from certain sectors in terms of the potential impact to margins and the bottom line. And I think in some ways we can't really dismiss that narrative that the Fed will need to remain in restrictive territory for quite some time. And certainly whether there's one or two more tweaking hikes from here, I don't think can be completely ruled out. And so that does lend itself to pressure in the Treasury market specifically as kind of the market adjusts to what is a higher for longer cost of capital environment. Now, as it relates to corporate credit, I think really it's all about dispersion. And so we think that higher for longer cost of capital environment will drive dispersion across asset classes. So whether that's public versus private credit, fixed versus floating, if you think about high yield versus leveraged loans, as well as sectors. So sectors with strong pricing power. Are you a commodity purchaser or are you a commodity producer? Arguably, those are kind of really important factors in this current environment. And then certainly at the issuer level, are you aggressive with your capital management structure? Have you been paying down debt? If you're doing M&A, are you funding that with equity or cash? All of those things will add up to success or not on a relative basis on how sectors and companies can navigate this environment.
Amanda, let's just stay on the energy component of that, the winners and losers of $90 crude. Right now, Brent is back through that level. For WTI, it's 9 days of gains. Incidentally, longest daily winning streak potentially going back to January of 2019. Now, Amanda, years ago, we used to talk about the high yield sector being very sensitive to energy. Just how energy sensitive is high yield now versus where it was, say, 5 years ago?
Sure. So to frame this, energy has probably been one of the more bondholder-friendly sectors in the high-yield market over the past few years because those companies have been really diligent in previous years about paying down debt, specifically coming out of the pandemic. So the sector in both high-yield and IG, for that matter, trades tight to the overall index. In terms of the sensitivity, when you're up at levels where we are in crude, so I would say really anywhere north of $50 dollars a barrel, and we're clearly well above that now. The sensitivity flow through to high yield isn't as extreme as you might think, because you're so far above the break even that the incremental cash flow to these companies, it's not going to make or break them in terms of a fortune perspective. And so really it boils down to, we know they have the ability to do bondholder friendly balance sheet repair, but do they have the willingness? So it's less about the price of crude at that point and more about what is the management philosophy on the balance sheet. I think for corporate credit investors, this is going to reignite this debate about input costs, margin pressures. We've gone through this to varying degrees over the past few years about, again, are you on the commodity purchasing side of things, or are you on the commodity producing side of things? And those have different fortunes associated with them. And I think that's really going to drive the dispersion. But energy is already at this point priced pretty tight relative to the broader markets. I think also the last time I was speaking with you, we had talked a bit about financials. And I think, this kind of also isolates some of the kind of unique capabilities of the financial sector in not being as exposed to input costs, not being as exposed to some extent on wage pressures and labor costs and freight and logistics. Those are different dynamics and conversations that we're having with investors. And if you looked at, say, just isolating U.S. investment grade, you look at financials and bank spreads relative to industrials, they're still hovering at levels outside of the March regional bank disruption. We're hovering at levels that we really haven't seen since 2012. And so that's a sector that I think is really coming back into focus for investors in terms of if other non-financial sectors are dealing with cross currents, whether they're higher input costs or wage costs, are there other places to look to deploy capital?
I often say this whenever we talk, but Amanda Lynham, that was a clinic. Amanda Lynham there of BlackRock. Amanda, thank you. Coming up, crude on a 9-day winning streak.
The potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time.
Team coverage up next.
Jeff Bezos realized you could sell anything on the internet.
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case
and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
The very earliest, you're talking about March, April of next year, before voters start locking in their opinions of the economy. So right now, the potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time.
Henry Trace there of Fader Partners weighing in on voters and gas prices. The Saudis and Russia extending oil cuts, doing Biden no favors at the pump. The White House weighing in.
What was announced today was a continuation of an existing policy, not a new set of cuts. The most important thing that the president is focused on is just trying to do everything within his toolkit to be able to get lower prices for consumers at the gas pump.
Airlines also feeling the pressure. United boosting its average price per gallon guidance for the quarter, writing this. Since mid-July 2023, jet fuel prices have climbed over 20%. As a result, the company's third quarter 23 all-in fuel price is now expected to be between $2.95 to $3.05 per gallon. Team coverage starts right now with Bloomberg's Anne-Marie and Will Kennedy. Will, let's start with you. Will, how rare is it to see gasoline prices where they are at this time of the year?
Yeah, I mean, they're very high on a seasonal basis, not far from being the highest seasonally since 2012. So it is starting to cause pain at the pump. And, you know, we saw from your chart there that we're not far off from $4 a gallon and on average throughout the US, which, as we know, is often seen as a point where people really start to feel the impact of high gasoline prices.
Well, it's odd this is happening at a time where people are talking down the prospects for the Chinese economy, and crude output in America is up close to all-time highs. Well, can you explain that?
Well, I think we need to take a nuanced view of Chinese oil demand and the Chinese oil economy. We've been talking to a lot of traders in Singapore this week, the team has, where there's a big gathering of oil executives, and they say that actually there are parts of the Chinese oil demand picture looks very strong. The gasoline demand has been flying over the summer as people take the chance in the post-COVID world to move around again. Jet fuel demand likewise has been on the up. And so China's crude imports have been pretty healthy. And that's on top of a world where demand has been strong throughout the world. Yes, there have been supply increases as well in the US, as you mentioned, in Venezuela, Iran. But I think a lot of those have played out. So when put together with the cuts, the extension of the Saudi cuts, I think a lot of traders are seeing quite a sort of bullish brew here.
Anne-Marie, how do you think the White House manages this message, particularly with crude output in America at 12.8 million barrels a day?
Well, it's difficult, Jonathan, because obviously we're talking about the gas price, the oil prices we see on our terminal, WTI and Brent. But when that trickles down across the refining process, that means higher gasoline prices on the side of the road. And we already know what this means for the administration. They're going to have to deal with this narrative about a tax on consumers. And already this administration has gotten poor remarks by how they were handling inflation, how they're handling the economy. When you see higher gasoline prices, that is only going to fuel that narrative. And Jake Sullivan yesterday said this is the ultimate metric of success, keeping gasoline prices down for the administration. Well, as Will just said, we're seeing on a seasonal level, this is the highest it's been in decades. So this is going to be a difficult one for them to try to tame down, especially as they tout Bidenomics. ahead of next year's election.
Very difficult, super tough. Will Kennedy, Anne-Marie, to the two of you, thank you. For the broader market right now, 23 minutes into the session, equities pulling back just a touch. We're down 0.25% on the S&P. Similar move on the NASDAQ. In the bond market, yields basically unchanged, down a basis point or so on a 10-year. The 10-year right now, about 4.25. Coming up next, your trading diary.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg.
2 days of losses potentially on the S&P 500. We're down here by about 1/3%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Fed releases its beige book at 2 p.m. Eastern Time. President Biden speaks at 2:15 this afternoon. Thursday, more Fed speak. Harker, Goolsbee, Williams, Bostic and Bowman. And another round of jobless claims. And on Saturday, the G20 summit begins. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck, of course, for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Erica Edelberg. She covers all the mortgage-backed security stuff for Bloomberg Intelligence. I need to figure out what's going on with the housing market, mortgage rates, all that kind of stuff. And then we're going to check in with Vanya Stavrakeva, professor of economics at the London Business School. Figure out what's going on over there with the ECB. And then let's talk about the real estate business, REITs. Stephen Brown, he's the Senior VP and Senior Portfolio Manager, Global Real Estate at American Century Investments. Are we buying REITs here? We got the 2-year Treasury at 5%, so why not? Let's take a look at the REIT business. But first, we'll kick it all off with Mr. John Tucker.
All right, Paul, and Matt, a top-of-the-hour data dump, numbers on the biggest part of the U.S. economy, services. This is, God bless you, this is an important piece of information. We're trying to gauge inflation pressures facing the policymakers at the Fed, and this is not Fed-friendly. The ISM Services Index coming in well above expectations, 54.5, beating the prior reading of 52.7. The prices paid index way above the prior reading, 58.9. The prior reading was at 56.8. So again, this is considered to be inflationary. The immediate reaction in yields, the 2-year, which is more reactive to policy, that is up right now 3 basis points at 4.99. We'll call it 5% right now. The 10-year yield is about 3 basis points higher. That is at 4.28. As far as stocks, they are lower right now. In the S&P 500, the best performing industry group belongs to energy, with oil hovering around $90 a barrel. Lori Calvasina at RBC Capital Markets says the spike in oil prices, that does cut a couple of ways.
The last thing consumers need at this point in time, especially as we're heading into the student lending issue, which is, engendering a lot of uncertainty on the street, is a spike in oil prices and gas prices. On the other hand, if we get the energy sector working, and I think that happens as oil prices move up, that does, potentially spark a shift out of growth and back into value in more cyclical parts of the market.
Right now, the S&P 500, 25 points lower, down 0.6%, 4472. Dow Jones Industrial Average down 125 points. The NASDAQ 100, 105 points lower. That is down 0.7%. So you can bet this latest data is going to be in the driver's seat probably for stocks and rates today. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that, getting that reporting on the ISM data coming in hotter than expected. Matt Miller, Paul Sweeney, live here in a Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so head over to that youtube.com thing and search Bloomberg Global News or Bloomberg Radio. That'll get you there as well. Let's bring in Billy Lipschultz. He covers the markets here, and we got the markets kind of paying attention here and reacting to what we saw coming out of the ISM. Bailey, what are you looking at this morning?
Yeah, we're seeing, as you mentioned, and JT mentioned, yields higher, stocks lower. So it is going to be one of those days, likely one of those weeks, just given kind of the dearth of individual news updates. Right now, you're looking at Apple, NVIDIA, and Tesla all down more than 2%. So markets, bigger companies, obviously weighing down on stocks. A couple individual names to keep an eye on. Right now, Southwest down 1.7% after warning of higher jet fuel costs. And one other company that actually is trading lower as well in the airline space, JetBlue right now down about 2.5%. This coming in addition to the fact that the company laid out that they have a system outage currently affecting bookings. So about a day after United Airlines was hit with some of their own issues, bit of uncertainty going on right now in the airline space.
Turn the computer off and then turn it back on.
Yeah, that works. Yeah.
That seems like what happened yesterday with United. Yeah. Because they had a nationwide grounding, and then 2 minutes later, it was okay again.
Everything's good. Yeah.
They couldn't find a pin small enough to press that reset button. And somebody...
Is that how it works for the
somebody,
nation's...
like, give me an earring!
All control delete, maybe? That works, right?
Yeah.
All right. Well, we had the airlines today calling out the higher fuel as going to be a pressure on margins, and we had George Ferguson on from Bloomberg Intelligence who follows the airlines. He said you got that pressure, plus it looks like domestic revenge travel starting to kind of peter out here. So he thought the 3Q numbers would be good for the industry. Now he's like, maybe it can be a little bit of pressure here.
Well, it's interesting this morning, kind of the divide. So in the downside, looking at the S15 airline index, your worst performers, JetBlue, Hawaii, and Southwest. Top performers, Alaska, American, and United, because United also did call out higher fuel prices impacting that. So interesting just to look at kind of the dichotomy that we're seeing this morning.
I think I'm the only person I know that did not travel to Europe this summer. Everybody went.
I will be.
I didn't go.
I thought it was just John Tucker and me. I thought that was it.
I've been holding down the fort in Hoboken, New Jersey.
But do you have a res for a future vacation?
I'm getting married next June, so I will be flying to Portugal.
Wow!
So
Congratulations, Billy Lipschultz becoming
off
a
the
man.
Market. You've been to Spain twice.
Twice in the last 2 months.
Yep.
Yeah, but that was not really like a pleasure trip.
But it was a pleasure trip. It wasn't business.
My wife brings me over there when she needs me to watch the baby. You know.
And you don't speak Spanish. So
I don't. But and the disturbing development this year is that my 2-year-old started speaking fluent Spanish and only fluent Spanish. So I have no idea what she's saying. My wife's like, here, you're in charge of the baby for the day, and then the baby starts, yo tengo frio, and I'm like, what are you saying? Yeah.
Maybe it's time to learn the language with a wife and
I speak German and French, so it's hard. I think of other languages, so,
All right. I don't know. I would go a little Spanish. I think I might put a little time into learning the Spanish.
I'm going to try Duolingo.
Duolingo?
Yeah.
Probably worth it.
I've heard Tom Keene says it's good.
Well, why don't you just have your wife? If everybody's speaking Spanish in your household, that's how you learn it, right?
Yeah, I guess. Is that how it works? I guess not at my age. If I were 2.5,
right,
no problem.
Bailey, what else you got for us?
Roku right now up 9%, laying out plans to cut about 10% of its workforce, also consolidating offices. So bit of optimism there, at least from an investing standpoint, with the stock up 9%. They also did unveil some revenue expectations that came in above what Wall Street was looking for. And I would be remiss if I didn't come on and mention meme stocks. AMC down 20% after announcing a share sale to sell up to 40 million common shares. That's part of...
Whoa, who's AMC is issuing common?
AMC, as part of their 2 weeks ago, they converted the APE shares into AMC shares, reverse split, opened the door to sell 390 million shares. So this is 40 and basically leaving the door open for another 350 million shares. Stock right now trading just below $11 on a reverse split basis. If you want to keep that same kind of underlying value, you go back to June 2021. It in theory was trading around $390. So
interesting. So yeah, stock's off 20% today. Wow, interesting. That'll be. I mean, it's just crazy meme stock, but I guess they need the money.
Yeah, they
at
have,
the end of the day.
In terms of lease obligations and debt, about $9.5 billion. So you have to do something. Yeah.
Good luck with that. All right, Bailey, thanks so much for joining us there. Bailey Lipschultz, he covers all the equity markets for Bloomberg News, and we appreciate him joining us here. Also joining us here in our Bloomberg Interactive Broker Studio is Erica Edelberg. Does not phone it in, does not mail it in. She shows up in the studio, and we appreciate that. She's a mortgage-backed security strategist for Bloomberg Intelligence, has been on the street for a number of years. We appreciate getting her time. I don't know, Erica, we got a mortgage rate north of 7%. What's going on in the MBS market these days?
Hi, good morning. Thanks for having me on. We actually are seeing a huge decline in mortgage demand, which is just, symbolic of the fact that the housing market's really freezing up. New homes are still doing okay. There's a way to for home builders to offer lower rates, and frankly, there's more inventory right now. I mean, it's about a third of the existing inventory because you can build a new home. You can't get somebody to necessarily sell their home if they're sitting on a 3% mortgage, and they'd have to take out a new 8% one, like Matt.
Yeah, not selling. Not selling.
Yeah, so the housing market's pretty frozen, and on a seasonally adjusted basis, the mortgage-backed security loan application index that the Mortgage Banker Association puts out just hit the lowest levels since 1995 or 1996. So I think.
So wait, does this mean for the mortgage-backed bond market that those are scarce and thus rising in price?
Yeah, it's an interesting, a number of interesting dynamics. I actually just sent out a little commentary today. It does mean that new issue supply is going to be very low, which should be a positive for the mortgage-backed securities market. But even so, even though a lot of these homeowners are well out of the money and they're not going to refinance, anytime soon, mortgage-backed securities are still sensitive to volatility, and they're still sensitive to what the Fed's going to do. So as a result, we kind of thought this would be a pretty good year for mortgage-backed security, not a lot of supply. We thought maybe the Treasury market would rally, once the Fed was done tightening, but that hasn't happened.
How many does the Fed own? Do they have a stack of mortgage-backed bonds in their vault?
The Fed owns about 2.6 trillion mortgage-backed securities. For the past 2 years during the pandemic, I should say in 2020, 21, they were waving them in hand over fist to help support the mortgage market and help support bonds overall. And they've stopped doing that because they want rates to rise now. They want to slow down the economy. And that's been a negative drag on the mortgage-backed securities market as well, just not having them in there as a buyer.
But they're not going to sell them, right? In quantitative tightening, they let the bonds they hold run off, and they don't. But they're not going to sell mortgage-backed securities.
I mean, never say never, no guarantees. Right. But they've said if that's happening, it's a long ways in the future, and they'll let the market have plenty of advance warning. So they're not making any noises towards it. About a year ago, some of the Fed governors were maybe they were trying to jawbone mortgage rates higher. Who knows? So they were saying, "Oh, we really don't want to own this many mortgage-backed securities." But there's also not been any move in that direction. So I don't think that's certainly not the base case of anybody's expectations.
By the way, what's your take on the long and variable lags? Because I've heard an interesting debate. Some people say because there are no more adjustable rate mortgages, except for Paul's, and everybody has locked in a 30-year rate, they're going to be even longer variable lags. But others like Jan Hatzius came out yesterday and said he thinks it's shorter, because the Fed telegraphs everything they're going to do so far in advance. And what do you think?
I think I can't really compare it to history. I think that if you look at traditionally movements in mortgage rates / housing market prices and rents, there's a pretty long and variable lag. But one of the things, aside from, perhaps the telegraphing, home prices are actually holding up very well. And I think that's a very key source both of rental incomes as well as people's wealth effect. So I think to the extent that home prices are kind of failing to fall at this point, I think that does actually make the lags relatively long.
So what's the mortgage-backed security market telling you about interest rates? I mean, people are talking about a Fed maybe in 2024 cutting rates, but you don't see that in the mortgage rate at all. 7.59% on the bankrate.com U.S. home mortgage 30-year fixed, 7.59%.
I mean, that's obviously a very current rate, right? Yep. It's not a forecasted rate. It's not really a forward rate, but it is based on, to some degree, the 10-year Treasury, plus some spread. And what that's telling you is that we've had, the curve is uninverted a little bit because the markets are telling you that that yields are going to have to stay higher for longer while the Fed continues to try to get inflation under control and slow down the economy a little bit.
Can I get any return in your market? I mean, I'm looking at the is it kind of flat year to date in terms of the mortgage-backed security return?
Yeah, it's flat so far,
yep.
Which might mean there's upside going forward. Spreads are very wide. They're kind of near 10-year wides. They're actually not as wide if you look kind of before the Fed started buying in 2008. In the post-financial crisis world, they're very wide. The Fed's probably not going to come in and save the mortgage market anytime soon. As you said, they're more inclined to sell, though I don't think they will. So as a result, there's a better buffer. You have a lot more yield, you have a lot more spread, but you have to have a little bit stronger stomach too, because maybe the Fed will continue pushing rates higher, or at least job loaning them higher. So that's what cuts into mortgage-backed security returns.
So again, today we had the MBA mortgage applications decline of 2.9% versus a prior period of a positive 2.3%. How unusual is that kind of swing period to period?
I think the best thing to think about when you're looking at something like the MBA purchase index being right now at the lowest rate since 1995, these are percentage changes off extremely low numbers.
Okay.
So if one more person takes out a mortgage purchase, it's going to influence the number. So I think the direction has to be looked at over a longer period of time, and we're down 30% relative to a year ago, and even a year ago, rates had already started rising.
Is there a rate where, I don't know, the market opens up, people start buying and selling houses again? I mean, at one point I heard somebody say 5.5% for the mortgage rates, get back down to there. But boy, we're a long way from that.
Yeah, we are. We're currently, as you said, at 7.5% on the bank rate. It's hard to put a number on something like that. I think part of it will be time as well, because just over time, people have to upsize their homes. Death, divorce, taxes, defaults. We're certainly not facing defaults anytime soon with unemployment at pretty much all-time lows. But that being said, time will help. More mortgages are getting originated, albeit slowly, at these higher rates, and those people, of course, aren't quite as locked in. But I think the mortgage market structure is going to stay, in the very low coupon range for a very long time. So I don't think we'll have the kind of turnover we're used to seeing in the housing market for a decade.
You know what's a great thing? Downsizing.
Yeah.
Nice. That no tax. Your cash burn is a fraction of what it was back in the day.
I'm excited for that to happen to me in 20 years or so.
And when you downsize, you can sometimes take out the entire equity of your home and not have to take out a mortgage at all.
Yep. So
those types of things will keep the housing market. And there is a whole bunch of people that are, in the next generation that are kind of ready to downsize, so those homes also
and then you
might
got
come
people
on the
like John
market.
Tucker who actually does the repairs to his own home.
Right. Well, he's never downsized. He still lives in the mansion overlooking the sea.
Okay.
But there is there's a guest cottage on the estate. So at some point, that's an
what
option.
you need to do. Yeah.
I thought he was going to say I could move in.
Yeah, you can move in.
Or at least stay there for the weekend.
Yeah, exactly, down to shore.
Bite your tongue.
All right, Erica, thank you so much for joining us. Erica Edelberg, she's a mortgage-backed security strategist for Bloomberg Intelligence.
At some point, we got to talk about porting mortgages.
Porting mortgages?
Because I locked in a 3% rate. And if I want it, I love my house. I'm not going to sell it. My wife's listening. Don't freak out. But if I did want to, I'd like to take my 3% mortgage with me and use it to buy another house. You can in some cases. I don't know the exact details, but some mortgages can be ported in some ways. So
in other countries, that's definitely true, like in Canada. But I haven't really heard of that being a thing here as much.
Canada.
All right.
Plus,
You can move to Canada. Well, you can't take your mortgage with you. So.
Take your mortgage with you.
All right, thanks again.
All right, we'll see you. Very good. S&P 500 off 0.5%. We're going to have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Enbridge is betting big on U.S. gas. Bloomberg's Gina Cervetti explains.
Canadian pipeline operator Enbridge has agreed to buy 3 utilities from Dominion Energy in a $9.4 billion deal that creates North America's largest natural gas provider. The deal will require approvals from regulators, including the Federal Trade Commission.
Now, Enbridge says the acquisition will double its gas utility business. Shares of Enbridge right now, they are down about 4.5%. Shares of Dominion Energy, they're down about 1%. Amazon could be getting hit with a lawsuit before the end of September. More from Bloomberg's Steve Potisk.
The Federal Trade Commission is ready to sue Amazon this month, capping a 4-year antitrust investigation into the company. Sources tell Bloomberg the case is expected to target the online retail giant's popular marketplace. Third-party merchants have complained Amazon unfairly ties access to the marketplace with its delivery service.
And shares of Amazon right now, they are down just a fraction. Meanwhile, Alphabet has tentatively settled claims that Google Play abuses its control over Android mobile applications. Now, details of the settlement, including how much Google will pay, they were not disclosed. Complaints were filed by users and attorney generals of about 3 dozen states. Now, a hearing on the status of that settlement, that is set for October 12th. Shares of Alphabet right now, they are down about 0.5%. And attention Kia owners, the car maker recalling nearly 150,000 2022 and 2023 Sorento hybrids, and Sorento plug-in hybrids. Issues with the rear-view cameras, well, they're causing images to be distorted. Shares of Kia right now down a fraction. Those are the company stories we're following. I'm Lisa Mateo.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are lower, yields are higher, and it's the data that's driving sentiment. This morning's ISM Services Index shows rising activity across the board almost. The prices paid index that bounced for the second month in a row. This is leading to inflation concerns. It's not a done deal that the Fed stands pat or cuts in the first half of next year. The more policy-sensitive 2-year Treasury yield right now, that is up 4 basis points. We're above 5% right now. Higher rates especially painful for technology stocks. And those are the biggest drags right now. Apple, Nvidia, Tesla, Amazon, Microsoft, they are all declining right now. Overall, the S&P 500, 25 points lower. That's down 0.6%. 4471 on the index. The Dow is down 95 points. The NASDAQ 100, 112 points lower. That is down 0.7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Brokers studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio or Bloomberg Global News. That'll get you where you need to go. Let's go across the pond and take a look at what's happening in the economies of our good friends in Europe and the UK. Dr. Vanya Stavrakeva joins us. She's a professor of economics at the London Business School. Professor, it seems like the U.S. economy is doing pretty well to the point where this Fed doesn't need to really do anything to kind of maybe, you know, we've got inflation kind of running okay. We've got the economy kind of running okay. Just give us the 30,000-foot view of Europe in general, and then we'll dig down a little deeper.
So thank you very much for having me. Always a pleasure to be here. So indeed, there is quite a bit of divergence between the U.S. and Europe, and definitely UK as well. Which is due to structural reasons. So the German economy, for example, if you take the biggest country in the Eurozone, is significantly different from the US economy. We would expect that inflation will be high in Germany, and would expect the inflation problem will be worse in Germany and to see stagnation or even decreasing growth, which is what the recent numbers show, based on a few observations. So first, the Eurozone and Germany in general are just much more open relative to the US. So if you take one measure of openness, which is exports relative to GDP, and just take China, which of course, as we know, has decreased its demand for imports due to the slowing growth in China. So the connection between Germany and China is 2.5% of the German GDP. So Germany exports 2.5% of its GDP to China. So an external shock from China is going to impact the German economy, for example, a lot. The difference is with the US, the number is 0.6%. So, of course, it's not just China. Actually, over the last year, the euro has appreciated against the dollar by more than 10%, close to 12%.
Vanya, can I just jump in here and ask about quickly about China? I keep hearing that the slump in China is affecting other economies badly, and everyone's kind of writing off the economy there. But aren't they pulling out some real stimulus now? Isn't it possible that the Chinese economy does start to pick up?
Well, they've been kind of trying to do it for a while. I don't think they're proposing anything new. I believe that China is on a downward trend. We're talking about a trend here rather than a temporary, essentially one blip deviation from growth. China cannot grow the way it used to for a number of reasons, which are quite long to discuss. So I do believe that actually the trend will persist in China.
Okay,
Sure.
I just wanted to get that straight.
Yes,
I believe
definitely.
you. I just have been a little bit confused because we report on every stimulus move like it's a huge deal. You know, like, oh man, they're cutting the triple-R reserve ratio, and they're funding, you know, little kids and old parents, and so. But I hear you.
I think it's important actually to zoom out and look at not just the recent news, but a compilation of news and trends. I mean, that's kind of what we do usually in econ, not just focus on a single news. Speaking of trends, going back to the euro, an appreciation of the euro of 12% is massive. Right? This is going to impact the Eurozone economy in Germany the most. Now, what else is different for Germany? So there are other major differences between Germany and the US, coming from the fact that Germany is primarily dominated by manufacturing. So manufacturing is still much more important in Germany than the US. So then the shocks associated with high oil and gas prices impacting the marginal cost of production for the manufacturing sector is another big problem, right? So those costs had to be passed forward to the final consumer for the manufacturing sector. So the prices of manufacturing goods had to increase more. So high inflation in Germany. Similarly, the labor tightness. So Germany has demographic problems. They have aging population, much more than the US. So you have seen the articles that the manufacturing sector is struggling to hire employees. Wage inflation is going to be higher. So these are structural differences that are here to stay. They're not going to disappear overnight. That are putting the US and Germany in a very different position. Now, this creates a lot of challenges for ECB, of course, because Germany is one of many countries in the Eurozone, and the German economy is also different from Southern Europe and from other countries. So then the question is, what is ECB going to do? I do believe that in general, ECB tends to put a higher weight on the German economy, high weight. That's what we saw during the global financial crisis, for example. Probably it will be the same in this case. Having said that, given that the news are high inflation above target and actually significantly above So more than 5% core inflation is a very uncomfortable situation for ECB. Even if the German economy slows down, even if there is a recession, I do not see how they're not going to keep increasing interest rates. We're not talking about inflation getting to 3.5%, and then having the theory that maybe they're targeting a bit higher inflation. We're talking about still 5% core inflation.
All right, how about the United Kingdom? What are we seeing in terms of the economy there, and what do we expect the Bank of England to do in response?
So for the UK, it seems that there's some evidence that the high interest rates are starting to bite. Having said that, the UK has the worst numbers in terms of inflation, in terms of private sector wage growth. I don't see them pausing for the time being. I mean, they cannot pause a disinflation rate. However, I do expect a recession coming the soonest probably in the UK relative to either Eurozone and UK. It's unclear which one is going to come first, but definitely we will have a recession in the UK because they will have to keep hiking, and even at current interest rates, it's going to bite. Already starting to bite.
What do you think about the release of the Strategic Petroleum Reserve last year? Didn't really affect the price of oil so much. Now we're heading back up there, even as these problems, of economic slowdowns hit whole continents like Europe. How does the oil price work into your forecasts for economic growth or contraction?
It's contributing to a slowdown. So we saw that gas prices are starting to increase again. So let's see what happens with the winter. If we have a mild winter, it might not be as bad. If global demand slows down, this might offset efforts by oil-producing economies to decrease the supply, which of course OPEC has been trying to do that. So it is a function of both supply and demand. So it is a function also for the oil and gas producers do, in addition to what happens to demand. I don't expect them to reach the levels, of course, of last winter unless there is another massive shock. But definitely are going to put a downward pressure on the growth in the Eurozone and in the UK as we enter the winter months, where we expect prices to increase a bit at least.
How about in Southern Europe? I'm thinking Italy, Spain. Those are economies that tend to be more fragile. And at least here in the U.S., we hear more about that from a weakness perspective. How are they faring in this environment?
Well, Italy is a special case. I wouldn't put it together necessarily with Spain these days. Besides Italy, other Southern European economies are actually having better numbers than Germany. They have lower inflation and better growth. So overall, actually, they're doing better. But if the ECB keeps hiking, of course, this is going to have an impact on those economies as well. The numbers for Italy do not look great. So definitely Italy, for a number of reasons, is an outlier at the moment. So that's where there'll be also political conflict because further hikes are going to potentially upset politicians in certain Southern European countries if they feel they don't need these hikes. So this has always been the problem with ECB, right? We have a single central bank, many business cycles, no common fiscal policy. So usually the weight is on Germany.
Yeah, that's tough. If your biggest economy is your weakest or one of your weakest links, that's tough.
Well, I mean, let's define weakest link. Surely the Spain, Portugal, Italy, Greece, those are going to be weaker economies over the longer term, don't you think, Doctor?
Oh yeah, of course. I mean, there is the trends and there are business cycle fluctuations. So when we talk about monetary policy, of course, the focus is on business cycle fluctuations, and that's where currently the divergence is such that Southern Europe is doing better than Germany. In steady state, of course, the fundamentals you can say are better for, countries like Germany than Greece or Italy for sure. So
right. You notice I didn't use the term pigs.
Why would you?
Yes, I do not like this term. It's a very
Portugal, Italy, Greece.
Yes.
Oh, yeah. That's
it's good. Actually, I think Portugal, Italy, Ireland, Greece,
easy on the Ireland thing.
Sorry.
All right, Doctor. Thank you so much for joining us, Dr. Vanya Stavrakeva, professor of economics at the London Business School. I appreciate getting the view of what's happening in Europe. All right. So you lived in Germany for a number of years. Is there still, from an economic perspective, and just an Eastern Germany versus a Western Germany?
Oh, yes, yeah. For sure. I mean, if you look at the map of Germany and, for example, take a map of Germany, put the headquarters of all of the 30 DAX-listed companies on the map, I believe, with few exceptions, I think all 30 are in West Germany.
Wow.
right? Just driving around East Germany and West Germany, you can see the difference. Not that there aren't beautiful places in East Germany. Dresden is gorgeous. You know, I love Leipzig. I'm a big fan of the East, but there still is a big divide.
Yeah, and that's interesting because we don't even think about it here, but you can see even since, I guess, 1989.
The chancellor has been an East German, but if you look in Parliament, almost everybody is not.
All right, interesting. We'll get to that's very interesting. Getting the first-hand view of Germany. Right now, let's head down to Washington, D.C. Amy Morris has got World and National News for us.
All right, thank you, Paul. On a surprise visit to Ukraine, Secretary of State Antony Blinken says the U.S. will ensure Ukraine is equipped to defeat Russia and rebuild its own economy. Blinken stopped in Kiev en route to the Group of 20 summit in India.
We want to make sure that Ukraine has what it needs not only to succeed in the counteroffensive, but has what it needs for the long term.
Blinken's visit also gives the U.S. an opportunity to consult before this month's UN General Assembly in New York. The U.S. Senate returned to Capitol Hill yesterday. All eyes on Minority Leader Mitch McConnell after two recent incidents of him freezing in front of cameras, once in July, then again in August. McConnell took to the Senate floor to address his health issues.
Now, one particular moment of my time back home has received its fair share of attention, but I assure you, August was a busy and productive month.
The Capitol Hill attending physician, meanwhile, did an exam and says he did not find any evidence of a stroke, nor a seizure, nor Parkinson's in McConnell, and that those freezing moments are common in some concussion cases. President Biden is rewarding his historic and heroic actions taken by a Vietnam War Army helicopter pilot. He risked his life to save others. Those details from Bloomberg's Nancy Lyons.
The president has given the Medal of Honor to retired Captain Larry Taylor, now 81, who flew his Cobra attack helicopter to rescue 4 members of a reconnaissance team who were surrounded by the enemy.
Taylor received a direct order, return to base. His response was just as direct, I'm getting my men out.
Taylor performed the extraction himself, a move never before accomplished in a Cobra helicopter. The Medal of Honor is the highest honor given to members of the military who display conspicuous bravery. In Washington, Nancy Lyons, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries.
analysis, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. You have two-year Treasury yields hovering above 5% right now. Stocks are lower, with technology stocks in particular selling off. This follows the top of the hour data showing service sector activity rising to a 6-month high in August. This does suggest the Fed's work is not done. Then you can throw into the mix Brent crude. That's hovering around $90. The move in oil also complicating the Fed's inflation fight. That's according to Tracy McMillian at Wells Fargo.
Elevated oil prices together with a higher core rate already means that, the Fed's going to have to remain diligent in their inflation fight. So it's probably increasing the odds of a rate hike in November. So markets are taking notice of that.
Right now, the S&P 500, 30 points lower, decline of 0.7%. 44 is 66 for the S&P 500. The Dow Jones Industrial Average, 148 points lower. The NASDAQ 100 is down 120 points. That's a decline of 0.8%. Delta Airlines naming Tom Brady as a strategic advisor.
Please.
What does he know about advising airlines? He says his mother worked as a flight attendant. Good enough for me.
So it didn't work out with FTX and crypto, and now he's going to do airlines.
Well, he's also going to serve in some capacity as like a team builder. So tell everybody, hey, go team. This is how we do it, I guess.
Apparently, he didn't even get a tryout for the Manning cast. Did you see that?
No.
The Manning brothers were doing auditions for another host, and they just left Brady sitting in the waiting room.
That's great. Some bad blood there, maybe. Whatever. Anyway, that's your market update. We update you all day long. Matt and Paul.
That's what we do here. All right, Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. Let's talk REITs, Real Estate Investment Trust. Steve Brown, he can do that for us. Steve Brown is the Senior Portfolio Manager, Global Real Estate at American Century Investments. He joins us live here in our Bloomberg Interactive Broker Studio. Steve, what happens to the REIT market when the Fed has 11 rate increases, there's a banking crisis? That can't be a good backdrop for REITs.
Sure. Thank you for having me on. Yeah, REITs have been under pressure this year and part of last year because of the Fed rate hiking cycle. And as you mentioned, it's going on for over 12 months, and they've raised short-term rates basically from 0% to 5%, so very materially higher rates. And it's impacted basically cap rates and borrowing costs for real estate. So REITs in general have been under pressure for the last, we'll call it 18 months or so. And we're really looking to an environment when the Fed is done raising rates, and that would be a much more constructive environment to own publicly traded real estate.
So you think rates are just going to stay here, or we're going to get a new dot plot this month? Do you think they're going to take out some of the cuts?
Right. I think our basic thinking is the Fed is either done or just about done. They could be done because they haven't raised rates since July. And as we move into 24, then the next conversation will be when do the cuts start? We think that when the Fed's done, that's a much more constructive environment for real estate values and public real estate. And we think that, we don't necessarily need the Fed to start cutting rates, but just having no more rate increases and some stabilization in the bond market, that'll be a much more pricing efficient market for real estate. So we're optimistic that the Fed is either done or just about done raising rates. And whether they start cutting in June of next year or September of next year, it really is just a more constructive environment when the Fed's done raising rates.
All right, so I know that there are lots of different sectors within the REIT space, data centers versus, housing and things like that.
Offices versus student housing.
Exactly.
Sure.
What are the ones that you guys are going to be positioned in for if we are, in fact, heading into a time when rates are no longer increasing? Where are you guys kind of placing your bets?
Sure. It's a great question. And, REITs are up about 2% or so this year, so not much going on. But certain sectors like data center REITs, industrial have done well this year because they have pricing power. And other property sectors have really, performed poorly. You mentioned office. That's certainly one of the weaker performing sectors, as well as net lease and to a certain extent retail. We think that if when the Fed's done, the asset class in general should perform better because of more effective debt financing for real estate values. And will the more bombed-out sectors perform well? I think retail is probably going to continue will perform better because of lower rates, and they have lower valuations, so they'll benefit from that. But some of the other sectors that haven't performed well this year, such as towers, tower REITs are—
I love towers.
Are a big component of the index. They haven't done well for a couple of reasons. One is the growth characteristics have been modest, and secondly, because they have sort of very strong pricing power characteristics, they had high multiples, but high multiples and high rates don't go well together. So if the rates start to roll over, tower REITs should perform well over the next 12 months also.
Paul loves towers because I'm going to guess he took somebody's towers.
American Tower,
there
Crown
you go,
Castle.
public.
We made the fees we made off of those things. Gold mines, gold mines. And we rolled the whole industry
For the
up.
bankers.
Oh yeah, we rolled
But
the whole
also
industry
good
up.
for the sellers, right? I mean, I remember when Deutsche Telekom took all their towers, they sold them and leased them back.
They thought that those assets were worthless, and they were worth 7, 8, 9 times cash flow we got them for.
Right.
So anyway, so we made money on the tower business back in the day. So here in New York City, you're a REIT guy, you're a real estate guy. When I see a high quality 3rd Avenue, 48th Street tower, when that gets sold in the next year or two, is it going to be 10% below where it was, 20%, 50%, more than that? How bad do you think the office market is in a market like New York? Because we haven't seen stuff really trade, so we don't know what the discount really is.
Right. It's bad in the sense that we've seen trades, whether they're New York, San Francisco, or other major cities. What we've seen is some funds, some private equity funds, give back the office properties to the lenders. And then the asset is worth less than the loan. So we've seen property declines over the last 12 months in the office sector of anywhere from 20 to 45% of transactions that have happened. So that's what we're seeing, and we would believe that office values are down anywhere from 20, 30, 40%. So if a property that you just mentioned hasn't traded in say 3 or 4 years, you could probably see a pricing that's 30 or 40% lower than what last traded at because of higher cap rates for office and concerns about NOI of the office buildings because of less tenant demand and the continuation of work from home.
What's the best way? I mean, REITs, you can go and buy them individually. There are also ETFs of REITs. There are a number of ways to get at the product. Does the wrapper matter, or what's your view on that?
Right. I'd say, certainly from where we stay, we run a actively managed long-only strategy, and I think that the diversity helps total returns, certainly for us and our clients. I think that there were, even though I mentioned that REITs were up only 2 or 3% this year, there are a number of property sectors that have done quite well, whether it's data centers up 20, 25%, industrial up 10 or 12%, multifamily up 7%. So there's been some real winners. So active management does matter. And I think as we move into 2024, and as we sort of get past the Fed rate hiking cycle and the environment changes somewhat, I think there'll be some continued strong differential in performance of the various property sectors as we move into 24.
Are there, I mean, the big losers, Steve, I'm guessing like office space here along 3rd Avenue, right?
Yeah.
Have they lost enough so that they become interesting in terms of, the multiples?
Sure. In the public sector, I mean, the office REITs at one point this year were down 40%. So publicly traded real estate reflected higher interest rates, reflected concerns about an economic slowdown, et cetera, et cetera. So they really had real-time pricing, and they would be the first to recover in terms of a recovery in the economy or a slowdown in the raise of rates. In the private market, the pricing has not adjusted so quickly. So it's clear today, and that's why REITs are trading at a 20% discount to net asset value. They're trading at a big discount to property prices, and they reflect both the higher rates and the impact of just a modest slowdown in demand for certain property sectors like office, which you mentioned.
All right, interesting stuff. Real estate investment trust. Steve Brown is our go-to guy, senior portfolio manager, global real estate for American Century Investors. We didn't get to talk about my favorite REIT, which is Lamar Advertising. Billboards also did that company public. Some news out there. WeWork intends to remain in majority of building and markets.
Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Shares of Apple are under pressure after reports that Chinese government agencies are banning staff from using iPhones at work. More from Bloomberg's Ed Ludlow.
The Wall Street Journal reporting that some central agencies in China have issued directives via chat rooms and in meetings that they should replace their mobile device in the event it is a foreign device, not just an Apple iPhone, but a non-domestic device. Apple have not responded to a request for comment from Bloomberg News.
Now, Apple shares right now down more than 2.5%. United Airlines, Southwest, and Alaska Air are all warning about higher jet fuel prices this quarter, with Southwest cutting its outlook because of it. Bloomberg's Abigail Doolittle has that report.
WTI crude up more than 35% from its low earlier this year. That really pressing into jet fuels. It's a classic inverse relationship between the airlines and that big cost component, oil. For the year into the peak back in July, up more than 43%, now down 30% from that as WTI crude and Brent crude oil has gone higher. And right about now, even the airlines up about 10% on the year. Crude oil up just a little bit more, up 14%.
Now, here's the difference. Shares of Southwest right now down nearly 2%. United Airlines shares, they are up 1%. Same for Alaska Air, up more than 1%. And some airline news of a different kind. Delta has named Super Bowl winning quarterback Tom Brady as its strategic advisor. Now, he's going to help with marketing, develop training and teamwork tools for employees. And here's a fun fact. Brady's mother worked as a flight attendant. Who knew? I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Looking at the market, we're off about 0.7% here. So it is U.S. Open time here in New York City, and that is big. It's one of the best 2 weeks, I think, of the year for New York sports fans. It's a great place to go. Molly Smith, she covers tennis for us, for Bloomberg News. I don't know what else she does for a living, but she's our go-to person for tennis. She joins us live here in our Bloomberg Interactive Brokers studio. So we were just talking, Molly, you've been not once, not twice. How many times have you been to the Open live so far this year?
5.
5 times.
Yes.
Unbelievable.
For 12-hour shifts.
And just as a fan, right? Not as a reporter.
A little bit of both. Yeah, we came out for our Business Week show that we do there. We were there on Friday afternoon.
Oh, right,
Yeah.
right.
Good time.
That's a
Carol
scam.
Tim.
That's a scam.
total
Carol
scam.
Master has been running that scam for damn near 20 years.
Very well, and she and Tim do it very well. All right, so what's the takeaway? So there's a lot of new names that are just grabbing the spotlight, isn't there?
I think today a lot of the excitement right now is around Ben Shelton. So he's now into his first major semifinal.
And he's an American.
He is an American. He's 20 years old. Beat another American, Francis Tiafoe, last night. And it was exciting. I was there for it. Ben won in 4 sets. And this is if you guys have been hearing about somebody serving at 149 miles an hour. This is the guy.
That's like Philip Koussa's level. You know?
It's close to Andy Roddick level. So
Right.
that's he's up there. Yeah, he's got a very live arm.
Okay, and see, some of these folks I'm now seeing, they're coming out of college. They don't go pro as early as they used to.
Yeah, and I think a lot of them will say that it's been really helpful for them. I think especially on the men's side when their bodies take a little bit longer to develop and that they just need to get those reps in before they're really fully ready to join the men's side. So Ben, coming out of the University of Florida, played 2 or 3 seasons there, and his father was the coach, and now his father coaches him on the pro tour.
Nepo baby.
Nepo baby.
He was a pro player too, Brian Shelton, if you remember that name.
I do not. All right,
Okay.
so how about stories on the women's side? That's to me, it's even more interesting, the women's game. So
How
what's
did you
happening?
Read my story?
What's that? I did.
You
did.
inspired it,
Absolutely.
actually.
Okay, good. It's good stuff.
Yeah, so Coco has been, she had a great win yesterday over Ostapenko. It was a kind of wild Latvian player who had taken out the women's #1 in the previous round. I think the next match that Coco has will be really interesting, and like either of these 2 players would probably be my pick to win it on the women's side.
So who's she playing next?
She's playing Karolina Muchova, who's now the new women's #10. Has had an amazing year, been in the final of the French this year and the final of Cincinnati where she lost to Coco. She just has a ton of variety. I think she's a lot of fun to watch. She's got really high tennis IQ and just as you can see that she's thinking out there. She's really smart. I think she's got a lot more weapons arguably than Coco does and a lot more consistency in using them.
Now, you're an economist.
Allegedly.
How do you know so much about tennis?
I grew up playing in high school, and I played in my club team in college, go Syracuse. And I used to teach tennis before I got my big girl job here. So this one is helping me make a better living.
And she knows everything about it.
So that's good.
All the players. I can't even pronounce their names.
My wife is Spanish.
Yeah.
So we're hoping for a repeat
Alcaraz.
of Alcaraz.
Alcaraz.
Like it ends with a TH. Alcaraz.
Alcaraz.
Yeah.
Okay.
Carlitos.
Chances of him winning again?
Hi.
Yeah.
Yeah. He's got a fun match tonight that I think he'll... Oh, wait, no, did he... Yeah, he plays tonight, sorry, against Zverev.
Okay.
And I think he will like to see that Zverev just went nearly 5 hours the other night and hopefully is nice and tired for him today.
So it's going to be, I guess the dream men's final would be Djokovic and Alcaraz. Is that right?
That's correct, the 1 and 2, yes.
Okay.
And I think that's what we've all been dreaming of, and the odds makers have had that from the beginning. So it would be exciting, if the Wimbledon final was any clue for that, we could be in for a very long Sunday afternoon.
Yeah, exactly. And on a related business note, the maker of Wilson tennis rackets just filed to go public.
Look at that, yeah. The great Roger Federer played with Wilson rackets, so.
Oh, is that right?
Yeah.
Oh, good for him. All right. They also make Solomon ski boots, so that's what I am down with.
Dude, they make the volleyball from Castaway, most importantly. There's a fish song about them, and they make pickleball
Molly Smith,
rackets.
thank you very much, Molly Smith, our tennis correspondent. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk. There's some news out on WeWork, so we're going to get the latest on what's happening with our friends at WeWork when we talk about the market. Then we're going to check in on what's going on in the energy space. WTI crude oil, $86 and change. That's had a nice move higher. We'll talk to Mike McGlone and Fernando Valle. They are both analysts of Bloomberg Intelligence. They cover the energy space, so we'll get some color there. Then maybe a little car talk for Matt Miller. Elizabeth Behrman, team leader for European Autos, going to talk about the $3 billion U.S. battery plant brought together by the pact between Daimler Truck, Cummins, and PACCAR.
Nice.
That's big. So we're talking
Cummins. They make some of my favorite diesel engines.
Really? You have favorite diesel engines?
Yes. The 6.7 liter Power Stroke.
Really? That's your fave. I wouldn't have picked that one.
Yeah, for sure. Over 1,000 foot-pounds of torque. Yes.
All right, that's
yes,
what we're talking about.
You like an engine that doesn't have a carburetor. Is that right?
Yeah, I mean, I have a very broad appreciation for drivetrains. So, yeah.
Oh, John Tucker, save us from this. Give us a little business flash here.
All right, right now it is risk off in the markets. A gauge of the service sector rising to a 6-month high. That's the data we had this morning. New orders, employment gains boosting the ISM Services Index for August. So in the end, what this suggests is that the Fed's work is not done. The data driving yields higher and stocks lower, especially technology stocks. With the recent rise in oil prices also, David Leibovitz at JP Morgan Asset Management says the Fed's job has become infinitely more difficult.
You're going to see the headline inflation number begin to move higher. At the same time, you have these higher energy prices, you have the resumption of student loan payments, you have a savings rate that has dropped relatively precipitously, and we wonder if the consumer is beginning to bend, not necessarily break, but show some signs of weakness. And this, again, creates a tension for the Fed.
And right now, the S&P 500, 37 points lower. That is down 0.8%. We're at 4460 on the index. The Dow Jones Industrial Average, 172 points lower. That's down 0.5%. And the NASDAQ 100 right now, 159 points lower. That is down 1%. The more policy reactive 2-year Treasury yield, that is up right now 6 basis points. We're at 5.02%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and check out Bloomberg Radio or Bloomberg Global News. Either one will get you to our feed. All right, let's talk markets here. We do that with Jess Metton. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. And we want to talk about one of the stories crossing the tape. WeWork to renegotiate nearly all leases, exit unfit sites. So WeWork is still a thing. And we talk real estate. We talked to Jeff Langbaum. He covers all the REITs and all the real estate stuff for Bloomberg Intelligence. He joins us via Zoom from the Princeton, New Jersey campus of Bloomberg. Hey, Jeff, let's start with you. Where is WeWork these days in the marketplace? What's happening with their portfolio of properties? What's the latest?
So I like the way you put it, Paul. WeWork is still a thing. Although I mean, it seems like they're hanging on, by a thread at this point. The news out today that they're planning to renegotiate all their leases. I mean, a renegotiation or a negotiation by definition requires two parties. It's going to be a wide range of outcomes in terms of what their landlords want to do and are willing to do. Obviously, you've got a market where office demand is light, and so if you've got a tenant that wants to stay in your building, maybe you'd be willing to give them a break. But at the same time, if they're saying they want to stay in their best properties, maybe those are properties where you're not eager to give them a break, because those may be properties that you could fill with a tenant on perhaps better financial footing. So it's going to be a long workout, just like the commercial real estate industry broadly is in the middle of right now, and it will be kind of interesting to see how it plays out.
So in terms of WeWork clients, how many of them have said, you know what, this is getting a little sketchy for us. We're going to go over and get some office space with Regus or another competitor?
Well, their occupancy rate has fallen, and so clearly the demand for their space is not nearly as strong as it was, and some component of that is probably tenants moving to someplace a little bit, stronger, in a stronger position. Some may be getting permanent office space, some may be just sitting and waiting, but some is just because the market is soft and there's not nearly as much office demand, and obviously that's the underlying problem for them is they've got these long-term fixed lease payments and the revenue's not coming in at the level that they expected it to be. So that's what's triggering the need for them to scale back. But without a bankruptcy, they don't have the ability to just walk away from leases, and clearly seems like they're trying to avoid going that route.
Hey, Jeff, you're the expert on this stuff. When we see an office building trade on, let's say on 3rd Avenue in Midtown Manhattan, what kind of haircut is it going to trade at? 50% from where it was before? Something less than that? Something more than that? This is going to be ugly.
Well, it really depends on where it was before is how that's measured, right? I mean, if you're talking about where paper values were at their peaks, you might see pretty significant haircuts in the range that you're talking about. If you're talking about trades relative to the last time a building traded, which may be a decade or more ago, might not be as bad. The issue really is going to be where are values now relative to where debt can be underwritten, because that's what's going to trigger the need for properties to trade is a financing situation, and we really just haven't seen enough data points yet to know, because while there's clearly distress in the market, it hasn't yet gotten to the point where enough distressed trades are happening to really know what prices are going to look like.
Yeah, it's going to be fascinating to see kind of where those values are in some of these big cities, New York, San Francisco. All right, Jeff, thanks so much for joining us. We appreciate you hopping on in short notice. Jeff Langbaum, he covers all the REITs for Bloomberg Intelligence. I want to bring in Jess Metton and get a look at this market here, kind of selling off on the back of some of that economic data we saw earlier. Jess, what are you looking at?
I'm taking a close eye because the client flows data from Bank of America did come out today. This is the data from Jill Carey Hall, who is a strategist at the bank. And so this comes out weekly. It's specifically geared toward the bank. So this is different than when you're looking at the more global data from EPFR that they typically model on Fridays. But I did a story last week with Bree Bradham on our equities team, and I spoke to Jill Carey Hall about this because there was 7 consecutive weeks of inflows into financials. And when you talk about financials, it's very broad because you can be talking about the banks. There's also consumer financial stocks when you're thinking about more fintech and credit card issuers that did get moved into that particular gauge, and then also the insurers. So after those 7 weeks, actually clients sold the financials for the first time since early July. But I was curious as far as who was it that was buying that, whether it was hedge funds, retail investors, or mutual funds. And it was actually mutual funds that were more underweight for that sector and cyclicals in general this year, particularly after what was happening with the regional banks. And they're actually adding more exposure more toward the consumer finance names. So like the fintech names, whether you're say like a Visa, MasterCard.
So but mutual
PayPal.
funds were underweight, and so
Correct.
they're adding.
Right.
And that's why you
so
see
that's
those,
why,
at least part of the reason you see those
right,
inflows.
Exactly. So when you're talking about financials, there's still some hesitancy when you're looking at the banks and the regionals, but it's actually more of the consumer finance corners of the market.
That's interesting that they buy consumer-facing finance at a time when you
Right.
think that the consumer is getting a little stretched.
Right.
You see a lot more credit card usage. You see delinquencies starting to tick higher.
And you have some of those stocks trading, around records too at this point. So it's interesting seeing that kind of positioning and something that I've been keeping a close eye on that's kind of been happening under the radar with some of these inflows data.
All right, what else?
So after the bell, American Eagle, GameStop, and then
Oh, we got more earnings.
C3 AI. So
Oh,
even though we
boy.
feel like we're through the earnings, there's still some key ones after the bell. So for GameStop, that's ticker symbol GME, that stock's up only about 4% year to date coming into today's trade. But this would be the first earnings report under the new leadership of Ryan Coram and the interim CFO, Daniel Moore. So get those 3 names coming after the bell today.
All right, we'll be on the alert for that. Jess Menton, thanks so much for joining us. Jess Menton covers equities for Bloomberg News. All right, let's talk global energy here. We got Brent crude. I'll just quote Brent crude. Since we hit $90 a barrel today, that got people's attention. Currently at $89.63.
You use CL1 for that? Is it CL1? CO1 is Brent crude. CL1 is NYMEX.
Yeah, I usually quote NYMEX because I like the guy, the wildcatters down in Texas and Oklahoma.
CL1 commodity.
All right, let's talk global commodity. What?
I'm looking to see, because last year in March, the Biden administration started issuing barrels from the Strategic Petroleum Reserve. And so what I'm looking to see is, are we getting back to those levels? Because at the pump, we're there pretty much. And if the Biden administration thought it was too high, the price, so they needed to release those reserves for the good of the American people at that time, they must think the same thing again now, right?
I don't know. Let's check in with a couple of experts. People who do this stuff for a living. Mike McGlone and Fernando Valle. They cover the energy space for us for Bloomberg Intelligence. Miami Mike is zooming in from Miami, and Fernando's here in our Bloomberg Interactive Broker Studio. Hey, Mike, I'll start with you. Big move higher here in oil. It's catching a lot of folks by surprise. We had some of the airlines today call out higher fuel costs here. What do you make of it?
It's a bounce that will fail. And I said the same thing last year when crude oils got above 100. My call was it's going to get to 40, and the low this year is 63. Okay, didn't get all the way there, but to me, it's just a matter of time. That's what crude oil always does. It fluctuates. It's the most autocorrelated asset commodity there is. When it jumps up, it squashes that demand, increases the supply. When it pumps, it drops down. It's the opposite. The key thing is what's changed. That's what it does technically. What's changed is this significant excess of supply out of the U.S. So I'm just looking at my data lately. The net exports from U.S. and Canada, liquid fuels this year is going to reach 5 million barrels a day. Just to put that in context, that's enough. That's liquid fuels. That includes ethanol and everything. That's enough to fill up the SPR, what we took out of it, in about 70 days. So this is a problem for the rest of the world, not for the U.S., particularly what OPEC's doing. And I'm sure Fernando can comment on that. But I look at what you see on the screen now is what I expect crude oil to do. Is it's got a major problem with the world tilting towards recession. Our model, the economics model, is 100% for the U.S., declining out of China, PMIs and everything declining in Europe, and central banks still tightening. That's the macro, and the micro is it usually fluctuates. And right now, I think it's really very much near the upper end of its range.
I mean, our model, Bloomberg Economics model, has a 100% chance for a recession, but it's fair to say the consensus on the street is for a soft landing. I mean, Goldman Sachs says 15% chance of a recession. I guess his model's slightly different than ours, I guess.
So, Fernando, what do you know from the fundamental perspective? What are you seeing out there? It looks like OPEC, if they want higher prices, they're getting it.
They're getting some of it, but I think when you look at just again Asia, as Mike was mentioning, that Germany's number is 11% down month over month today on the industrial orders. Who's their biggest trading partner? China. I think the demand side, as Mike was saying, is really the biggest concern. And if we do have a recession, you can't keep $90 a barrel. And I think there's a discrepancy here on our views versus the street, that when Saudi and Russia agreed to extend their cuts to the end of the year, they're basically saying demand looks soft to us, not we're going to keep pushing prices higher. They're saying we don't have a market in Asia. And so that's not a great news for anyone who's bullish oil. We just extended that because we're not finding that supply balance yet. And as Mike was saying, we continue to grow. I think that growth is going to moderate. We're going to miss expectations on U.S. shale just because the pace of drilling is lower. The cost of financing is lower. Remember, shale is an ever-going treadmill. You're always reinvesting because you have 90% declines in the first year. So the shale producers will feel higher interest rates right away, higher inflation right away, because they're constantly drilling and drilling again to maintain their production.
Well, it's hard enough to get them out there to drill, to put new holes in the ground, right? Because not only are interest rates rising, but they're afraid of regulation, certainly under this administration. What do you think about the SPR release and its effects, Mike? I mean, I'm looking at the chart for NYMEX crude, we didn't go to 100 until March 1st of last year. We stayed there until July 20th, and the crude releases, the SPR releases began at the end of March. Did they have a significant effect?
Well, I still think President Biden's going to go down in history as one of the best crude oil traders ever. He actually did the right thing, what you're supposed to do in backwardation. You sell the liquid and you buy the futures contracts. Obviously, they haven't bought them back yet, but we just don't need it anymore. We have an excess supply of crude oil. If we shut off our exports, we're going to have way too much of it. So I think it's just a matter of time it gets refilled, but we don't have to do it anymore. And there's one thing I wanted to tee you off on, Matt, is when you go to Europe in 12 years from now, you will not be able to purchase an internal combustion vehicle. This is where we're going.
He's trying to get my goat.
Get a rise out of you.
And what I'm doing right now is I have this strategic internal combustion engine reserve at my house. I'm just stockpiling gas vehicles.
I'll take the other side, and then I'll say if Europe does that, you'll be able to buy Europe for that at that point, for the price of an internal combustion engine car.
All right, so Fernando, what are your companies telling you about where they think oil is going?
I mean, they have not cut investments at all, so they are seeing the undersupply long term. But in the short term, they just want to, as Chevron says, win in any environment. I think they have continued buybacks, and that is the biggest difference in big oil today versus big oil in 2019. Is they cleaned up their balance sheets so they can afford to continue that share repurchase program even at much lower oil prices. And I think if you ask Mike Wirth of Chevron or Darren Woods of Exxon, they would say, yeah, give us a dip on our stock price, because we would love to improve our returns on capital by repurchasing some of our shares rather than going out and buying more small E&Ps.
I don't know. I mean, can I go down to Texas and start drilling? I mean, I think I can make money at $90 a barrel.
You would think, but you can't find the tubular goods, you can't find the labor, and you're sure not going to get permits to drill a lot of those wells.
That's no fun. All right, Mike, from the commodity space, just right away here, what's your number one call?
Gold. The average price of gold this year at $1,933 is the highest ever. You can't say that about virtually any other commodity or asset so far. Expected to continue. And the deepest pockets on the planet are buying gold. That's central banks.
And Fernando, just real quick, what are your clients? What's like the most in vogue trade you hear from your clients?
Well, people are going for the soft landing movement, and we think that's not quite going to play out well for them. So they're still buying some of the petrochemical names that are exposed to housing, some of the E&Ps, the more levered E&Ps that are now getting a rise out of the higher oil prices. And we think safety, especially when you're getting a huge payout from Exxon and Chevron, is a more attractive proposition.
All right, good stuff, fellas. Appreciate it. Fernando Valle, Mike McGlone, they cover the energy space for Bloomberg Intelligence. Mike, more from a commodities perspective. He covers all commodities for BI. And Fernando from the fundamentals, the equity side for a lot of the big oil-producing companies. It's great to get both of their views when we're talking about the global energy space. WTI crude oil off just fractionally today, $86.53 a barrel for West Texas. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. Shares of Albertsons are higher after word that the grocery chain, along with Kroger, is selling stores to CNS and SoftBank to help with their merger. Bloomberg's Katie Greifeld has the backstory.
Kroger agreed to buy Albertson in that $25 billion deal last October. The end product, of course, would be a U.S. grocery giant with nearly 5,000 stores. And at the time, to soothe those antitrust concerns, the company said that they would sell up to 375 stores, which brings us, of course, to today. And it's not clear so far how many stores CNS would be acquiring or how much they would pay for them.
Now, shares of Albertsons right now, they're up about 1.5%. Kroger right now up more than 1%. Roku says it plans to cut about 10% of its workforce. The company also raised its guidance. Bloomberg's Isabel Lee says that's good news for the struggling streaming platform.
Roku is among the tech and media companies that have earlier this year faced prospects of weakening sales as advertising pulls back. And the company last year warned its investors of a tough economy ahead. In March, it also cut back some 6% of its workforce. But because of this recent update, it seems like it's going to be good news for the stock moving forward. We have Bloomberg Intelligence saying the outlook suggests revenue gains are re-accelerating and the job cuts should help overall profitability.
And shares of Roku right now, well, they're up about 8%. To the housing market now, where a gauge of mortgage applications fell to the lowest level in 28 years. The Mortgage Bankers Association Index, it decreased 2.1%. Now, all this as the contract rate on a 30-year fixed home loan fell to 7.21%, but still remains near its highest level in decades. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. S&P 500 extending its drop below 4,500. Well, the NASDAQ 100, that is down about 1%. You have Tesla, NVIDIA leading a sell-off in big tech there. The Treasury two-year yields hitting 5%, and swap contracts showing bets on a Fed hike in November, climbing to 60% from about 50%. With a stronger than estimated reading on U.S. services industry, the ISM Services Index this morning in the driver's seat for these market moves today. S&P 500, 37 points lower. That's down 0.8%. 45.59 on the index. The Dow Jones Industrial Average, 219 points lower. The NASDAQ 100, 151 points lower. And again, the two-year yield right now, 5.02%. That is up 6 basis points. As we check Brent crude oil, that's COA commodity, 89.77 right now. And NYMEX crude, that is right now up 9 cents, down 9 cents, I should say, at 86.60 a barrel. That's CLA commodity. But if you want on your Bloomberg, type BOIL, B-O-I-L, go, and you get every single stinking grade of crude oil that there is. And there are very, very many.
You're right.
That is awesome.
There's one there, I think it's like Wild Horse is one of them. You know, the Brent, obviously, West Texas, and they're all sorts. So it's pretty cool.
It is cool for us old people. You know, the kids are just going to have a battery chart like this. They'll have every kind of chemistry that you can possibly use to make a battery to power a car. Let's talk about that right now, because Cummins, famous for its diesel engines, is going to build a $3 billion battery plant with help from the Chinese. And there's a lot of skepticism at these kind of partnerships, concerning these kinds of partnerships, including skepticism that Ford faced building a battery plant in Detroit recently. Let's bring in Elizabeth Behrman. She wrote the Cummins story for us. She's out of Munich right now. Are you in the office? You're not at the show, right? Did you go to the show?
I was I was at the Munich Car Show from Monday through to yesterday, and already having lots of fun with it over the weekend. It's been a great experience.
All right, so what do we know about this plant that Indiana-based engine manufacturer Cummins is gonna build with China's EVE energy company?
Yeah, such an interesting development. And as you were just saying in your intro, Cummins is a diesel engine maker, and they're having to get ready for what's up next. They're picking Daimler Truck as one of the partners in that venture, the world's biggest commercial vehicle maker, and then also PACCAR. And I think that's absolutely the right way to go, choosing partners, strong partners, to share the load and gain scale to drive down the costs of switching over to batteries.
It surprised me, given all the rhetoric we see out there on the geopolitical stage, why is China's EVE Energy Company a part of this transaction?
Well, because they have the technology. I mean, EVE is not exactly a company that's coming out of nowhere. They are a partner with BMW. And obviously, there are these geopolitical tensions with the US and China. It hasn't stopped other companies from teaming up with them. You were just mentioning Ford. And, you know, there's absolutely no way around the fact that out of the top 10 global battery suppliers, 7 of them are Chinese. So whether you like it or not, there's kind of no way around working with them.
Does everybody have enough battery capacity, Elizabeth, or are they building these factories quickly to try and get the capacity they think they're going to need 5 years, 10 years out?
You know, it's really interesting when you're comparing where the truck makers are and where the car makers are. The car makers are a lot further down the line, as we know. And just coming into this conversation, I was just having a look around, you know, is this the first of this kind in the US, you know, supplying batteries for trucks? I think it is. We've got one announcement from Volvo over here in Europe. So they're at this much earlier stage of moving into this shift. And hopefully they can learn from some of the mistakes that the car makers have been making, which is to partner up much earlier than they did in order to save costs. Because unlike with cars, obviously, truck makers